Hello, how does that sound? Yes. So if we could all take our seats, please, and we'll get underway. Just a few seconds. I'd just like to trying to locate a couple of councillors. We've located Councillor Walker. He's in Seoul, Korea, and so he will be he won't be joining us on Zoom, but he'll be watching us on Zoom, watching the line. Oh, he's joined, yes, so he'll be watching the live stream. And expectation is Councillor Mayhem and Councillor Hurleham will be here soon.
Trying to get hold of him.
So, in the meantime, we'll get underway. So, all councillors present will have a copy of the agenda, which is good, and we have the assembled board, members of the board from DCHL. Thank you for being here today, and thank you for putting this workshop together for us, because we have had a lot of consultation with people, residents of Dunedin, and it's good to have that right of reply from DCHL and the access to a range of expert opinions on the matter. So at this point, I'd like to introduce Mr. Tim Lone, Chair of DCHL, who will make some prefacing comments.
Thank you, Mr. Mayor, and thank you all for your attendance. I'll just ask if we can have the agenda slide brought up. So, as you can see, we have a structured program for today's session. The workshop is intended to be entirely public, with the exception of an optional non-public session at the end, if required. This will only occur at Council's request if there needs to be discussion on price or commercially sensitive information. The purpose of this post-consultation workshop is to really focus on areas of concern that have come out from the public consultation on the proposed sale of Aurora Energy Limited. We believe this decision is crucial and merits the time being set aside by both councillors and DCHL to fully investigate it, as it will significantly impact our community, local economy and the future of Dunedin. Before we kick into it, I just want to reflect back on why we are here. Specifically what councillors have asked of DCHL. Could we just move to the next slide, please? Although prior to my time on DCHL, a process was embarked upon with DCC undertaking an investment review and, in consultation with Deloitte, coming up with a draft investment framework. You can see from the slide on the screen the key objectives from this framework were protection of capital, diversification, liquidity, sustainable and regular dividends, and market returns over the medium to long term. Following on from this, for the past 2 years, the Dunedin City Council has requested DCHL in its annual letter of expectation to provide strategic options for consideration. This includes evaluating the future composition and direction of our portfolio. The goal is to allow the DCC to consider the implications as shareholder with a particular focus on dividends and return on investment from DCHL. To focus on these strategic options, the DCC wanted to get suitable expertise around the table and recruited 2 investment bankers. Actually, I will get you to forward to the next slide as well, because that just shows what was in the letters of expectation over the last 2 years. So to focus on these strategic options, the DCC wanted to get suitable expertise around the table and recruited 2 investment bankers. On my right and left, Chris Milne and Greg Anderson, to the board of DCHL. And DCHL itself set up an investment subcommittee. Initially, Keith Cooper, the previous chair of DCHL, was part of this subcommittee. Chris, Greg and I now form the investment subcommittee of DCHL, chaired by Greg, reporting back to the full board of Dunedin City Holdings. It's important to note that Chris and Greg are and will remain completely independent. If a transaction were to occur, they will not have any financial interest in that transaction. They were not brought in to sell assets, but to provide additional expertise for DCHL in the areas of evaluating investments, capital structures, and generating return on investment. We recognise the importance of the public consultation and the valuable feedback we have received. Public input is crucial in this decision-making process. To ensure the Council can make a fully informed decision, we have organised today's presentations to provide further expert opinions around certain areas of concern raised by the public. We are aware that there has been some public criticism of DCHL for wanting to hold this workshop and address some of the views put forward through the public consultation. I want to assure the DCC and the public that DCHL respects the public submission process and believes it is critical given the importance of this decision. While public feedback is invaluable, it is also important that we seek independent expert advice on these matters. As you will see from the agenda, we have several presentations lined up. The presentation times vary depending on the subject matter. We kindly ask that you save your questions until the designated question time at the end of each presentation. This will ensure that the presentations proceed smoothly and that we can address concerns raised thoroughly. In addition, there will be a 30-minute question and answer session with the Chairman and Chief Executive of Aurora. This will provide an opportunity to address any broader or more detailed questions that you may have. After today's workshop, we will be providing written reports. Our presenters will be noting any questions and concerns raised during the course of the workshop and ensure that their reports also address these matters. Thank you again for the time and effort put into this proposal to date. I'm aware there has been a lot of material and plenty of reading to get through. Our apologies for some of the acronyms and jargon. Our presenters will try to minimise the gobbledygook today. Your commitment and engagement with us is appreciated. As I've noted already, this is our response to the expectation that the DCC has of Dunedin City Holdings. As a board, we believe that progressing the proposal to sell Aurora Energy Limited is the right decision for the DCC and our city. Today, we hope to assist you, our councillors, in making an informed decision that best serves our community's interests. At this point, I'll hand over to Greg, who is chair of our investment subcommittee, and he will provide further background and introduce each of our presenters.
Thanks, Tim. Good morning, everyone. As Tim said, I'm Greg Anderson, and with Chris Milne, we are part of the subcommittee that's been looking at the investment strategy and has been working on the recommendation. Before we get to the independent experts, we just thought it would be useful to have a relatively quick recap in terms of where we're at today and how we got here. Most of this material has been presented to you before in the workshops, so hopefully nothing new, but I think it's useful to have this recap before we start listening to the independent experts. And apologies, this is going to be a little bit clunky because we don't have the clicker. So where are we at today? Oh, maybe we do. The portfolio is undiversified, illiquid and unbalanced. It is the DCHL portfolio consists of 4 assets, and as you see in the chart, there is dominated by value by Aurora. These values are based on the 2021 latest valuation. And I'd suggest that if we were to update that valuation or those valuations based on market value today, the dominance of Aurora would be even larger than it suggests there. So in portfolio management terms, the portfolio lacks diversification in both geographical terms, but also across industries or by assets. 66%, or let's say 70% by value of the portfolio is represented by Aurora. Given the nature of the assets, and these are legacy assets which weren't chosen by DCHL, the portfolio is weighted to growth and not income, and that will become more evident as we go through the discussions today. We've already said Aurora is by far the largest investment, and all of those investments are illiquid. What do I mean by that? I mean that none of the value of those investments can easily be converted into cash if that were what we wanted to do. The next slide, and apologies, a little bit hard to see, but again, reiterating what we've said before, the top graph looks at the dividends paid to DCHL, the cash distributions, the dividends paid by DCHL by company since 2011, when the total distribution paid to the council was 18.1. The colour's a little bit hard to discern, but the lighter colour is Aurora, and the majority of the distribution made back in 2011 was based on an Aurora distribution to DCHL of $12 million. You'll see the light shaded part of that graph diminish to the point where 2017 was the last year in which Aurora paid a dividend, and it was a relatively small one at $1.5 million. The next bar up is City Forests, which has the dividends from City Forest have grown a little bit through time and are now reasonably consistent. And the smaller bit at the top, or the second to smallest bit, is distribution from Delta, with a very minor distribution from the airport. But the general trend across that period is a decrease in the dividends that have been paid to DCHL by the subsidiary companies. The bottom graph then shows what DCHL has been able to pass on to the council. And again, similar trend, started at a much higher distribution to the council of 15.9 million, and then reducing through time down to since 2016, the only distribution made by DCHL to the council is the $5.9 million, which is the interest paid from DCHL to the council on the to service the debt that DCHL holds on behalf of the council. 2023 saw a resumption of dividends. $5.5 million dividend was made last year. But we'll explain in more detail in a moment what happened to allow us to make that distribution. You've seen this slide before, and I think it's quite helpful to demonstrate the translation between the income received by DCHL from its subsidiary companies to what DCHL is then able to pass on to the council. So where's our sources and uses of income effectively is what this slide is showing. DCHL relies heavily on dividends from its largest investments, which are Aurora and City Forests. As I said before, no dividends have been received from Aurora since 2017. We are servicing debt, that debt which is owed to the City Council, and we're also, at the direction of the Council, funding Dunedin Railways. So we just go through the sources and uses. This is for FY24. You will see that we've received a dividend from City Forests. We expect to receive a smaller dividend from Delta, and an even smaller distribution from the airport. From that, we've paid the 5.9 in interest to the council. We've paid a little bit of interest to DCTL, the Treasury, for another lump of debt. We've funded the railway to the extent of $2 million, and then we've met some operating expenses. The big difference, and the reason why we're able to step up the dividend in 2024, is we have received a special dividend from City Forests, which is off the back of the value that's accrued in City Forests from its carbon credits. But as you see there, in order to reach the DCC target of $11 million, DCHL needs to borrow another $5.2 million to top up the requirements from the council. The story's similar. We expect it to be similar for the current year, the year we're just starting, FY25. So dividends from City Forest, ordinary dividends from City Forest, from Delta, from the airport, the same interest payment to the council, the same support for for Dunedin Rail, and minor or relatively modest operating costs. Again, we're expecting a special dividend from City Forests, but still have a significant deficit in order to get the total distribution up to the target of $11 million. The next slide shows the expectations for the next 10 years, and a little bit of interpretation required here. So the graph is showing the expected distributions, or the ability of DCHL to pay the council distributions, excluding our expected funding of Dunedin Railways, excluding any further special distributions from City Forests, and excluding any dividends from Aurora or from continued borrowing by DCHL. And you'll see in the early years the ability to actually meet the interest payment, the $5.9 million interest payment in 25 and 26 is challenged. That improves 27 and 28, and then in the out years our ability to distribute money to the council increases to those numbers shown there, 11.6 in 33 and 12.1 in 34. And that's largely off the back of improved performance at City Forests. But in order to get to the target of $11 million distribution, which is the dotted boxes for 25, 26 and 27, dealing with the 3-year period for the latest SOI, we have a deficit on the basis that we haven't borrowed further and there's no distribution from Aurora and no ongoing special dividend from City Forests. So Aurora's capacity to pay cash dividends is critical if the council continues to require a material cash return from its investments. I guess that's the key point we're trying to make here. And it shouldn't be a surprise. Aurora represents 70% of our portfolio, and if that's not in a position to pay a strong dividend, then DCHL will struggle to pay a strong distribution to DCC. So with that background, we then move into summarising our proposal, which is to sell or to hold. From our point of view, from DCHL's point of view, the Aurora sale proposal is the strategic response to council objectives, and those are the points that Tim was making at the start. We've been directed to look at what can we do to assist with cash distribution to the council, not only in the short term but in the medium and long term as well. And our conclusion was, DCHL board conclusion, is if the council requires a different outcome, it needs a different asset mix. We're not questioning whether Aurora is a good investment. In fact, we believe it is a good investment, and value could be achieved by DCC by either holding or selling that asset. The question which we tried to ask through the previous workshops, and we reinforce here, is Aurora the right investment to meet the objectives that Council has articulated to DCHL? Our proposal to sell, and with that in mind, we determined that the best outcome was to sell Aurora. The proposal delivers significantly higher cash distributions, which is important. That is directly addressing the council directive to increase cash distributions. But there's other very important benefits as well of the sale that flow from the sale of Aurora. The first is diversification. At the moment we're holding a portfolio arguably worth upwards of $1.5 billion, which is dominated by one asset, and that is not good portfolio management. We're exposed to the single asset risk of holding one business, and we're exposed, given where Aurora is based, to the geographic risk as well. We're also mindful, and this isn't a key driver, but it is an important element to keep in mind, that DCHL, on behalf of the Council, is managing the group debt exposure, and for reasons which we'll go into in much more depth through the day, retaining Aurora presents challenges in terms of the group debt position. And the last objective is, if we sell Aurora, depending on what we do with the proceeds, we can reconstruct a portfolio which has greater liquidity. But in order to address the issues that we've been challenged with, it should come as no surprise that Aurora is the key. It represents 70% of the value of our portfolio. So if we are going to do something that makes a difference, it needs to relate to Aurora. Yes, we can do things with the other assets, but are they truly going to move the needle? The obvious starting place is Aurora. Let's just talk through some of the implications of not selling Aurora. If the Council chooses to hold, Aurora requires significant ongoing investment, and this will be a theme that you'll hear throughout the day, and there's no avoiding that. And if we DCC continues to hold that asset, that investment will by necessity be partly funded by debt. A number of experts will talk about the network growth and the drivers which are leading to that, and the Chair and CEO of Aurora will talk to the same theme as well. That investment will be required over a prolonged period, and certainly over the period that we're projecting, in the next 10 years, there will be significant investment required into that network to meet its challenges. Which aren't unique to Aurora, which all of the industry are facing. But given Council has limited access to capital, in fact you'd say we have zero access to equity capital, that investment must be driven by either retained earnings or debt. There is no other choice. If the Council requires dividends from Aurora through that period to fund its own operations, Aurora at the margin may be able to restart dividend payments at some point through that period, but our strong contention is that those distributions will be lower than what we could achieve from a diversified investment fund. And as was said before, group debt will increase further, elevating financial risks. So again, we don't want to focus on this, and it's not the key driver, but it is important that the group debt position will be challenged if we retain Aurora, and as a good asset owner, we invest in its infrastructure over the next 10 years, because that will have an impact on core council debt and the group debt exposure. So, again, reiterating the same point in a slightly different way, holding Aurora will put funding pressure on the DCC group. And we've only got DCC only has a limited number of levers to deal with that. If there are lower cash distributions, especially in the short to medium term, what does that mean for council? That means it means higher rates, lower expenditure on services, or higher debt. Those are the only ways to deal with a lower distribution from Aurora. And what we're saying, and the company will have the same view, given the required investment profile, Aurora will be unable to pay dividends from free cash flows in the foreseeable future. So while the asset value is increasing over time as the company reinvests in the network and the value of that network increases, which is all a good thing, it's still not generating free cash flow. So in order to pay a dividend, it would have to borrow further in order to fund that. As we said at the start, and we've been consistent on this view throughout the consultation and the workshops, Aurora is a good asset, and if it's retained, its value will increase. and nobody's arguing about that. And if we continue to hold it for the next 10 years, there will be strong capital growth expected based on the reinvestment which we're making in the asset. Not from rampant capital growth, but from reinvestment in the asset. However, the side effect of that is it's already 70% of our portfolio. If we continue to reinvest strongly into that asset, the concentration risk, the lack of diversification, which I spoke about before, can only get worse. We're driving the value of Aurora up, and assuming that the value of the other assets doesn't increase markedly, then the proportion of the total portfolio represented by Aurora will become higher than 70%. And again, from a portfolio management point of view, let's just say that's suboptimal. So value will go up if we hold it and if we continue to invest in it. The challenge for a council owner is turning that increased value into cash. How is that going to benefit the future ratepayers of Dunedin? So it will either need to generate cash dividends, or at some point it would have to be sold in the future. It's the only way that we're going to generate the value out of holding this asset for another 10 years. As we've just said, there is uncertainty about when this asset will generate free cash flows, which will allow it to pay dividends without increasing debt. And the second point, and another factor which led to our suggestion that now is a good time to sell Aurora, is that we believe there will be a significant premium paid over and above its book value in the current market. And we've been quite open about this too. We don't know whether that premium will persist. That if we make the decision that we're going to hold the asset for another 10 years, continue to reinvest, and then at some point a future council might make the decision to sell the asset, we don't know whether that value premium will still exist at that point in time. And I challenge anybody to suggest they know that it will or won't occur. What we can say is that in the short term, the premium is available. I've already said the portfolio is overweighted to Aurora, and as the value of Aurora goes up, then that overexposure to Aurora will continue. And we've got the same problem, we will have the same problem then as we have now, the geographic lack of diversification. We are focused on an asset which is exposed to Otago, and therefore the value is exposed to catastrophic risk for anything that might happen in Otago as well. As Tim said, we've listened to the consultation and we've taken that seriously. And we appreciate this is a significant decision for council, and some major concerns have been raised. The purpose of this workshop is to ensure that the council is fully informed. That's all we're trying to do here. Ultimately, we acknowledge that the decision to sell or to hold Aurora is a council decision. We are just doing our best to ensure that councillors have all of the appropriate information to make that decision. We've read all of the submissions, we've listened to the evidence, and this is our summary of the key themes that we believe came out of that public consultation. Four key questions, I guess, or statements. One, the assertion that the sale of Aurora will lead to higher lines charges, and that's a legitimate concern. We're not stepping back from that. Second is that Aurora is a strategic asset which DCC must control. And always in these conversations, I suggest we put inverted commas around strategic. What does strategic asset actually mean, and why do we need to control that asset? The third strong theme coming out of the consultation is that Aurora is a very profitable company and has debt capacity to pay dividends. We don't argue with the first point. Aurora is a profitable company. It will earn a regulated rate of return. We do, however, have some questions over the second part of that in terms of its debt capacity to pay dividends. I've already touched on that, and that will be re-examined throughout the day. And the fourth question, or the fourth statement, is that the sale's a one-off cash grab and the benefit will be short-lived. And again, we believe that if it's managed properly, the proceeds from the sale of Aurora are managed properly, that issue can be dealt with. But rather than listening to us, I'm sure you're sick of that already, we've engaged 4 independent experts to give a view, to provide some analysis and insights to assist Council in understanding the key issues which I've summarised this morning. These experts are independent from DCHL and from DCC. And Tim's already mentioned that following today's presentations, there will be written reports that not only cover what's covered today, but also have the potential to address any other key concerns that councillors might provide today, and we strongly encourage that. If we haven't covered all of the concerns that you believe was covered off in consultation, we're more than happy to do that. As I said, there's 4 key themes which are listed there again, and the first 2 themes will be covered off by an expert from SAPRE. The third question around Aurora's very profitable company has debt capacity to pay dividends. We'll have some evidence from MAFIC, Specialist Infrastructure Advisors, and then 2 experts will give us some insight into statement 4. The sales are one-off cash gain and benefit will be short-lived. So first of all, from Neil Holdham, who most of you will know, is the Mayor of New Plymouth and has some good background and experience from New Plymouth's experience through time with PowerCo, which we think is germane to the discussion happening here. And then we'll get some very high-level advice from Forsyth Barr in terms of what is a reasonable expected rate of return from our assumed use of proceeds of selling Aurora, which is the diversified portfolio. So with that, and slightly behind time already, I'll ask Toby from SAPRE to...
Yes, we'll just have a few questions if there are any at this point. So we have a question from Councillor Wiley, but firstly, Chief.
Just councillors, the GSOs are putting the slides into big tin can, including the introduction. So while you've got them emailed, they'll be in the can in the next 5 minutes.
Right, so Councillor Wiley.
Thank you, and thank you for that presentation. I note nowhere have I seen addressed, and you sort of summed up the pluses and minuses in your presentation. Why is there not an option to sell partial, like 40%?
It's a good question, and it's a question which will be addressed by MAFIC, and can I just suggest we defer until after their presentation? It definitely will be touched on.
Very good. Are there any other? Councillor Houlihan.
Thank you. Something quite a lot of the members of the public have said to me is, if you're going to sell, why would you sell after you've done a lot of work and not before? Obviously the price would be lower after you've, before you've done the work, but it's they're not handing over an investment that's really fully...
Well, there's 2 responses to that. The first is that we know that selling now will attract a premium to book value. And we, as I said before, there's no guarantee that that premium will persist into the future. The second most important point there is we have to fund that growth. And as we'll talk about today, and I touched on before, Council's not in a strong position to fund that growth.
Okay, thank you.
Can I just clarify here? I was under the impression that Mr. Lone was wanting questions to be done at the question time after the presentation. So I just wanted to make sure we're asking at the right time.
I assume that was after each presentation.
That's correct. Yeah, that's correct. There will be opportunity following each presentation for questions.
Otherwise, it's a long wait to get right to the end.
So I think roughly we're anticipating each session there'll be a presentation for about half of the session, and then the remainder of that session will be available for questions.
Right. Councillor Barker. And then I have, Councillor Vandervis, then Councillor O'Malley.
Thank you, Mr Mayor. On slide 10, it talks about $5.9 million interest paid to the DCC. Can you just clarify the history of that? Because I don't necessarily know if people will be aware about how that happened.
So my understanding, Councillor, is that when DCHL was formed, there was $112 million worth of debt that was structured into the company at that point in time. The 5.9 million is the interest on that debt, and as you can tell by the fact that it doesn't move up and down, it is at a fixed interest rate, and so that is the amount that is distributed by DCHL to DCC in relation to the debt that was structured into the company at the outset. I can't give the full background as to why that was done at the time, but the options were some debt, all debt, or no debt, and I think the decision was some debt.
Thank you. Councillor Vandevers.
You've highlighted, Greg, that the current market has a really quite premium value for Aurora. Is this premium value partly because Aurora is seen internationally as a safe kind of investment, and that the international situation is that there is a lot of very large investment funds currently looking for a safe investment, and also the Chinese government is in the process of perhaps nationalising some of their billionaires' assets, and they too are looking for a safe haven for their massive funds.
We can confirm that there will be strong interest in the asset from infrastructure investors and non-Chinese infrastructure investors. I can't speculate on the motivations of potential Chinese investors. What I can say, and this isn't specific to Aurora, all of the EDBs, 27 EDBs in New Zealand, have similar attributes which would excite interest from infrastructure investors. And they're driven by the fact that it is a safe, regulated business, and that's why they would pay a significant premium to book value. The other key element which drives this is that all of those investors acknowledge and accept that all of these assets require significant further investment in the short to medium term. And they like that because it allows them to deploy more capital. They don't necessarily require dividends from that asset on an annual basis, which in a perfect world is what DCC would get, and therefore quite happy to invest for the long term and that capital appreciation.
Right. Councillor O'Malley.
Thank you, Mr Mayor. I think also I'm sort of following Councillor Gilbert. Maybe we should also limit to one question per person and then move on, because we may not get to lunch otherwise.
Well, that's right. And we'll see. Typically, there's a few questions.
I want to follow up then Councillor Vandevers' statement about your surety that the premium is its maximum now and would go away. What's the calculatable evidence for that, rather than I feel that it's happening? Because one of the issues we need to know is you're making a statement that there's certainty now and there's uncertainty in the future.
Yeah, sure, and that's a valid question. I think we've been quite clear. Well, I hope we've been quite clear. We do have confidence that in the short term that premium will be available. As I said in my introduction, we don't know whether it's maximised now, and we don't know whether it will persist in the future.
My question is, what's the metric you're measuring to give you that confidence?
There is no quantifiable metric to give that confidence other than we know from incoming inquiry across a number of asset divestment processes that interest in this type of asset is strong. We talked through the workshop process. There's limited evidence. As I say, there's only 27 of these assets. 2 are already, or now 3, but prior to the Tairafti process, 2 were privately held. Tairafti, which is one of the smallest, far smaller than Aurora, was sold 2 years ago, and that did generate significant interest from the sorts of investors I'm talking about. So that gives us confidence that there will be strong interest in Aurora, which will present as a far more attractive asset than the Tairāwhiti network did.
But just before, but that was 2 years ago and it's still here. So why the statement that you're uncertain that somehow it would, given that you've also just made the statement that there's no actual quantifiable way to do this, so this is effectively I have experience in the area, I know what I'm looking at, I have a feel. I just really want, because it's a critical component for us, is that what is the underlying...
Sorry, your microphone.
What's the underlying reason to say that, given the Tairāwhiti distribution company got sold and was of interest 2 years ago, you believe that interest is still here, but you're not sure about it being out there? And I really am asking that, what's the basis for saying that there's no surety out there?
Well, we're all more confident about what might happen in the short term than the long term, in all respects. And that's the basis which I'm relying on that. But, as we have continued discussions with a number of advisors through the process to give us confidence that that statement remains true, because nobody wants to go through a prolonged sale process to find that nobody's interested in the asset. I can't give cast iron assurance, but the confidence is extremely high that this asset will be well sought after. And I guess to give councillors confidence around that, we're not proposing to sell this asset at any value. So if the value's not there, we won't be selling.
And my question wasn't on that. It was your statement that if we don't sell it now, we really won't be able to sell it in the future. Because I think that's around what
Sorry, I never made that statement.
I didn't hear that.
I never made that statement, and I'm quite open about I don't know whether that premium will persist in the future. What I do know is it exists now, and if we sell now, we can take advantage of that.
Right, thank you. Did you want to say something?
Only that we are committed to a reserve price, and we'll have those discussions in a non-public session to ensure. Yeah.
Yep. Thank you. Councillor Benson-Pope.
Thank you. Previously, you've raised it, and you've done again today, namely the issue of our too many eggs in one Otago basket concern. Even though we do know that adverse events, be it earthquakes or flooding disasters, do happen, I'm struggling to see why that's so much of a problem when these assets are insured, I'm sure, and in the case of Aurora, have wide disbursement right across the whole of the region. Why is that such a concern?
Well, the first point is, and Steve and Richard can talk to this better than I can, but the network assets aren't insured and are uninsurable. So an earthquake impact on the network would be significant, and it's uninsured.
Right, thank you. Councillor Houlihan again, do you have a question?
That's a shocker, isn't it? Why are they uninsured?
Perhaps just to get a little bit more clarification around that, Steve Thompson, would you care to comment on that point?
Yes, certainly. We've debated insuring and sought insurance, but there's no EDB in New Zealand that has currently insured its network assets because the cost of insurance is so significant that you couldn't justify it.
Thank you. Councillor Gilbert.
Thank you. I've got two questions that I'll throw at you both at the same time, and feel free to answer them as you want to. Further from the AF8, well, the conversation you've just been having, you mentioned AF8. AF8 is a risk, but my question would be, are we not then better placed to attend to our city and our region if we are the ones in control of the lines company? That's question one. Question two is that you've made comments about the confidence level being high, that there will be significant interest in it, we'll be able to get a premium price, etc. The purchaser, I'm assuming, would presumably either see value in selling it for parts or more hopefully keeping it for the long term, which then has me wondering, we see 10 years, what happens after the 10-year mark? And I understand that, as you've said, the shorter term you're more confident, you're more guessing further out, but have a guess.
Deal with the first question first. If there's AF8 event, is the city best placed to deal with its assets? The city's going to have its hands full with quite a lot of issues at that time. So actually having another counterparty deal with the resurrection of the network would be a good thing. So that's my view on that. In terms of what happens beyond year 10, I guess I'd defer again to Stephen Richard to talk about that. Is there likely, and we've been asking the same questions, once we get through the decarbonisation investment profile, which we all expect we're going to have to meet, nobody really knows for how long and how much, is it likely that capital requirement's going to drop off such that we're effectively generating lots of free cash and can pay those as dividends? And again, I'm not well placed to make that call, but there is, I think, and we'll ask Richard and Steve to talk to this, a good chance that heightened level of capital expenditure will continue beyond that 10-year period.
Thank you. Rightio. Thank you. We've covered those questions, and so now shall we move on to our next presentation?
Thanks, everybody. So welcome to Toby from Sapere. I'll get him to introduce himself and reacquaint you with what we're covering. But if you go back to the 4 key questions that we're trying to cover off today, Toby's evidence will address the first 2 in terms of the effectiveness of regulation to ensure that a new owner, a private owner, can't do what they wish with lines charges being the key focus. Welcome, Toby.
Thank you. Tēnā koutou katoa.
And you just need to press the button on your microphone too.
Thank you.
And bring it a wee bit closer, please.
Tēnā koutou katoa. It's always a pleasure to be in Dunedin. I've been asked to provide an informative and informed and objective view on the impact of economic regulation on Aurora's line charging and investment. On the screen you see 3 questions which I will address in turn. The first question goes to whether a different owner would have any latitude to raise prices or lower quality more so than would be the case under Aurora. The second question is, whatever I say about the first question, the second question is how enduring would the regulatory framework be? The third thing is, having looked at the regulatory framework, are there any attributes of an owner better or worse placed to look after the network and look after the consumers of the 3 sub-networks? So question number 1, what is the scope for Aurora to raise line prices across the network, or rebalance lines charges amongst consumer groups, or defer maintenance to save cost, or underinvest in the regulatory framework? And my high-level answers are there is no scope for Aurora to raise lines charges beyond what's allowed by the Commerce Commission under Part 4 of the Commerce Act. Secondly, the scope for Aurora to rebalance lines charges amongst consumer groups is confined at the very margin to a judgment on the allocation of costs between consumer groups or between geographic regions. Finally, in summary, the scope to defer maintenance or underinvest is limited by the transparency of the Commerce Commission's information disclosure requirements, limited by director liability under Schedule 17 of the information disclosure requirements, which requires directors to sign off on the asset management plans, the reputational risk of failures on the network, and you all know what that feels like already, and the risk of a fine which would come out of free cash flow, net profit after tax, if you are fined for compromising your quality and service standards. And again, you've already experienced that. So, the regulatory framework describes two functions. One is the Commerce Commission, which protects against extraction of monopoly rents by lines businesses, and this is through the application of regulations governing price and quality. But importantly, these regulations aim to ensure that consumer interests are promoted regardless of ownership. The Commerce Commission has its own legislation, its own statutory objectives, and is an independent body, independent of any ministerial interference. The Electricity Authority has a lesser role, but an important role nevertheless, looking at the finer detail of distribution pricing. The electricity also has its own legislation and statutory objectives, and it is also independently appointed, and its statutory objectives includes overseeing reliability and economic efficiency amongst its members. There are two main instruments that we'll be talking about today. One is the default price path, and I go through there in detail describing the default price path. It's in the name, it's the default price path. It's a shorthand for the maximum allowed prices and minimum service standards that all of the electricity distribution businesses, the EDBs, are captured by. We're going to go through how those maximum prices and minimum service standards are created and how they interact. From time to time, networks find themselves in a situation where they need more investment, more spending than would be provided under the default price path, and they have the option of applying for a customised price path. So, for example, after the Canterbury earthquakes, Orion had a CPP, a customised price path, and more recently, Aurora has got one of these to reflect their specific circumstances. Under a customised price path, the regulator approves bespoke allowances for what an electricity network business can invest, the consequential charge to the customers, and minimum surface levels over the specified period. It also comes with a higher level of scrutiny and accountability than under the DPP, the default price path. You could see I've written there the central plank from an Aurora perspective is an asset management plan, and the 2020 asset management plan supported the application focused on additional investment required to reduce risk and improve network safety reliable following years of underinvestment and under-maintenance. We're midway through the CPP, and the midpoint reports are starting to be released by the Commerce Commission. The CPP gives Aurora the ability to recover additional costs through line charges for the purpose of fixing, upgrading and maintaining the network. The other limb of price quality regulation is the service quality standards. So quality and reliability standards set by the Commission reduce the risk that EDBs seek, electricity distribution businesses seek, to increase profits by cutting costs and compromising quality. I said earlier, these regulations put a cap on prices and a floor on quality. I know every distribution business in the land have got assets that were put in place in the 50s and 60s. But in December 2016, DCHL commissioned a report on the state of the network at the time, and they found that an underinvestment on asset inspections, condition monitoring, planned maintenance and asset replacement over the previous 25 to 30 years. So that puts you in a unique category, and this is the root cause of where Aurora finds itself today. Current board and management are in the process of delivering a compliant network. The point there is that the challenge of upgrading the network is a higher challenge than is the case with the other distribution businesses around the country. And a lot of the efforts going in around the country are around the efforts of decarbonisation with its central plank of electrification. So every lines business finds itself with those old assets. Every lines business finds itself having to deal with decarbonisation and electrification. But Aurora had put itself in a more compromised position, and it's in the process of working its way through that. Price quality regulation starts with a revenue cap. I've written there that EDBs can recover what the ComCom consider are efficient costs to deliver the required quality by the way of revenue cap. That sentence turns on efficient costs. So using an approach called the building blocks approach, the Commission looks at the asset management plans and decides whether the costs that are built into the asset management plans are consistent with what an efficient distribution business needs to spend to maintain a reliable and safe network. They add to that a regulated rate of return on the investment. So that's not an unlimited rate of return, it's a capped regulated rate of return on the regulated asset base. That then creates a revenue cap for all EDBs. If the network business, the distribution business, is less efficient than the efficient costs that the Commission has awarded, then that may compromise their profitability. Don't let anyone come in here and say that this is a license to print money. It's not. It's a regulated return available to distribution networks that are efficient. On this next slide, I have drawn a picture I have drawn from some of the Commerce Commission material and set it out in two blocks so we can see how the revenue cap operates. From the asset management plan and an engagement with the Commission, a 5-year, for the duration of the regulatory period, a 5-year revenue ask is created, and that's built up, as I've said, with allowable operating costs and a regulated return on assets, and that's the top left box, the projected annual building blocks allowable revenue, including regulated return on capital. However, the Commission is going to allow the EDB to recover that from consumers, and they can't have it lumpy, they want it smoothed, so that's exactly what they do. That's what the diagram on the top right shows. They smooth the building blocks allowable revenue across the 5-year period, and they create maximum allowable revenue that can be recovered from consumers. If the rate at which lines charges increase is not steep enough to accommodate recovery of all that maximum allowable revenue, the EDB is allowed to defer income. It goes forward into wash-ups. This is a burden, this is a cost for lines businesses. They incur the costs today, but they can't recover the revenue from consumers until the future, so they have to fund that expenditure while they wait to recover it. In the bottom panel, I start with 1 year's maximum allowable revenue on the left-hand side. This is unorthodox, it's conventional. The only difference in this portrayal is the fact that because it's a regulated business, it's not all of its allowable revenue, it's its maximum allowable revenue in that year. Normally referred to in operating revenue, but in this world it's maximum allowable revenue. They then deduct OPEX the conventional way, less depreciation and interest, less tax, which gives us net profit after tax, or net income or profit. And there, the directors of Aurora have choices. They can pay down debt, they can invest more, they can spend inefficiently if they want to, they can pay dividends. They are the choices it has to make, and of course if it's fined for compromising its quality, that doesn't come out of OPEX, that comes out of free cash flow as well. It's a straightforward arrangement, there's nothing hidden or sneaky. However, questions have been raised about deferred revenue, so I have a whole slide dedicated to deferred revenue. I've already said this, but I'll repeat it again. Deferred revenue is the deferred recovery of efficient costs that have been allowed by the Commerce Commission when the MAR is calculated. Nothing novel or underhand there. The need to provide for some revenue deferral to accommodate the rate at which revenue could be recovered was very well documented in the Commerce Commission's 2021 final decision on Aurora Energy's proposal for CPP. It is what it says it is. And for completeness on this slide, I have the quote that appears in the annual report. Unremarkably, it sits in the notes to the financial statements. It's note number 3 of some 30 or 33 notes. And it explains the Commerce Commission's customised price quality path included a 10% limit on the annual increase of line charge revenue, although the increase in lines charges can vary and has varied. It included a 10% limit on the annual increase in line charge revenue in order to reduce the price impact on consumers, as I've described. Combined with the impact of volume-driven revenue variances, the total deferred revenue for the year ended March 23 is 39.3 million, and for March 22 is 13.4 million. You will hear people talk about the projection for deferred revenue. The deferred revenue will be recovered from consumers in future financial years. It is transparent, it is unremarkable, and it's a cost on the distribution business while they wait to recover that revenue. So that maximum allowable revenue creates the price path for the whole network. All of the distribution businesses are then facing increased scrutiny about how they allocate that amongst their consumers. So there's 92,000 consumers here, different sizes, different groups, different geographic locations, and different quality of the network in their areas. The Electricity Authority has a framework for pricing methodologies aimed at ensuring that one group of customers does not subsidise another. And like the Commerce Commission's workings of the price quality regulation, the distribution pricing methodologies has also advanced over these last few years. And the boxes on that slide going from left to right are Aurora or any EDB starts with determining how much revenue Aurora can collect, approved the allowable revenue from the Commission. That revenue, for the purpose of pricing, is allocated to pricing areas, geographic areas. That's how much Aurora can collect from each subnetwork. And each subnetwork is allocated to customer load groups, so that's how much Aurora can collect from each consumer group. It then sets cost-reflectable variable targets. They calculate the unit prices that deliver the target revenue. They set non-distortionary fixed tariffs, which test for cross-subsidy, i.e. are all prices fair? That is a very quick romp through the regulatory regime. It is a slight expansion on the consultation document, which says at the back in a section titled, "What does the proposed sale of Aurora Energy mean for me as an energy consumer?" And it reinforces that very, very, very brief statement on the whole regulatory regime. But for completeness, here is my summary on the key implications for consumers based on the regulatory regime were the owner to change. Revenue recoverable through lines charges is capped by the Commerce Commission, and the regulations apply to all non-exempt EDB owners. Lines charges cannot be increased more than allowed by the Commission. Deferred revenue is a function of smoothing prices through time, which in turn constrains the maximum allowable revenue in any year. What is deferred is the ability to recover allowable and incurred costs. The nature of the owner of the EDB has no bearing on this. Aurora's allocation of line charges amongst consumer groups is transparent and consistent with the Electricity Authority's pricing principles and guidelines and oversight. There's minimal scope for cross-subsidisation between consumer groups. By minimal, I am talking at the very margin between where two analysts might have a slightly different view on the allocation of some costs, but it has to go to one party or another. So you can't suddenly introduce a cross-subsidy. Service quality standards are factored into the allowances included in the building blocks allowable revenue and therefore the maximum allowable revenue. The asset management plan content, information disclosure requirements and director sign-off of the asset management plan are an integral part of the quality part of the regulatory framework. As the Commerce Commission would have it, and as Aurora would have it, as any regulated electricity distribution would have it, investing too little or too late reduces security and reliability. Investing too much or too early pushes up prices for consumers. In a period of risk and uncertainty, that is the balance that everyone is trying to achieve. And that would be the case, whoever the owner is. And I conclude there by saying consumers' exposure to price and quality for line services are protected, whoever the owner of the EDB is. There were two other questions. The second question was how enduring is the regulatory framework in Part 4 of the Commerce Act? Part 4 of the Commerce Act, the stated aim is to protect outcomes consistent with those produced by competitive markets, including providing incentives to invest, innovate and make efficiency gains while requiring suppliers to share gains with consumers and to limit excessive profits. It does what it says it does. It's hard to see the circumstances whereby the fundamental premise of the stated aim is undermined by a future government. A little more detail on the next slide. So I've talked about the purpose of the Commerce Act. I've talked about the fact that the Act establishes an independent Commerce Commission, which plays a role in making sure the markets are competitive, consumer interests are protected, and sectors with little or no competition are appropriately regulated. I've talked about the Electricity Authority's role. Softening the promotion of competition in markets or regulation in sectors with little or no competition would be a major shift in government policy. The framework has been improved over time. I'm sure it will continue to improve, but it has not been redirected in any way by successive governments of any political shade to date. Question number 3. What is the likelihood that the community would be better off or worse off if Aurora was owned by a party other than the DCC-DCHL? I've said and I'll say again, consumers are well protected by the regulatory regime and that protection is not owner dependent. I mentioned up front that every EDB in New Zealand faces the challenges of high investment required to accommodate electrification, which is in turn a consequence of New Zealand's legislated decarbonisation goal. I added the fact that all EDBs face ageing assets, but Aurora is dealing with its own self-inflicted situation. It is dealing with fixing and upgrading and maintaining its network after years of under-maintenance and under-investment. Aurora's owner will have to be more resilient and far-sighted than would normally be the case, and consumers could be better off with another party if DCC-DCHL doesn't have the resilience required to get through the coming years. I haven't formed an opinion whether they do or don't have that resilience, but that's certainly a topic of discussion, and you'll certainly be able to look through the MAFIC presentation with that lens and ask yourself whether DCC-DCHL, as the owner, does have does or does not have the resilience required to get through the coming years. And my last slide, I actually look at the attributes for EDB owners under price quality regulation with the decarbonisation challenge. Over the coming years, some of the attributes the ideal owner of a regulated EDB might need are long-term investment horizons allowing a flexible dividend policy, the ability to deal with a great deal of uncertainty risk and try and get into that sweet spot between investing enough and in time and not investing enough and in time, access to capital, specifically cost-effective debt. The owner will need to be comfortable with debt-to-equity ratios that are consistent with the Commission's regulated cost of capital over each regulatory period. It'd be handy to have experiences with other regulated businesses. It'd be handy to have economies of scale through these coming years. It would be handy to have synergies with other similar businesses, especially other regulated network businesses. And of course, it's important that they have an understanding of the challenges facing EDBs through decarbonisation, which is anchored heavily on decarbonisation of electrification of transport and process heat. Thank you very much.
Thank you. We have the first question from Councillor Vandevers.
Thank you very much for that and for the technical explanation of the Commerce Commission and their role. You said, you mentioned Part 4 of the Commerce Act. How long has that Commerce Act been operative?
Substantially since 2001.
Sorry, you have to restart your microphone each time.
Thank you. Substantially since 2001, but the current form has been operating since 2009.
And the best argument that I've heard from the public regarding issues around regulation have been, if regulation has been there for so long, how was it that Aurora was able to, for some 25 years, underinvest and not do appropriate maintenance? The question really is, how long has the Commerce Commission been effective in controlling line companies' investment?
I'll take the story out. I would take the story out from 2009. There were investigations of Aurora, and I understand in 2016 that the Commerce Commission then was bringing a great deal of scrutiny to bear on Aurora. Events jumbled together at that stage, and the Deloitte report was called for. I don't think that it would take so long for the Commerce Commission today to detect underinvestment and declining quality, and the consequences would be borne much more quickly. The information disclosure requirements and the scrutiny of the asset management plans is much more invasive, much more comprehensive, and a much greater engagement between EDBs and the Commerce Commission than was the case between 2009 and 2016.
Thank you for that. So essentially what you're saying is that effectively from 2009, this oversight of the lines companies was being developed, but that the Commerce Act was already in place then.
That's correct.
My other question relates to access to capital. Given not just electrification and decarbonisation, but the expected massive growth of Central Otago, especially in terms of lines requirements, what options does Aurora have or could have in the next 5-10 years for raising very significant amounts of capital, raising debt, in fact? What options does it have say compared to some big overseas fund manager that has very deep pockets and can easily raise that kind of money, what is the advantage that a deep-pocketed international investing fund company have over Aurora in terms of being able to raise massive amounts of debt?
That's outside my brief, but it's in MAFIC's brief, so they will be able to address that.
Thank you. Councillor Gary?
Thank you for your presentation, Mr. Stevenson. Several questions. The first one is your comments about the regulatory framework, and we heard in a lot of our submissions from the public a certain amount of a lack of confidence that would remain. And I wonder what your comments would be if we drill down a little more into that. People are very uncertain about things at the moment. You're saying that past governments haven't changed that regulatory framework. Could you talk a little more about your confidence that it won't be changed? Because I think that's the issue for people in these uncertain times.
Turn my microphone on. I did say that lines charges wouldn't be able to be increased any more or less by a different owner. I didn't say lines charges won't increase. Oh, they will. Do you question about the enduring nature of the regime? The regime is based not on the level of price increases, but on the protection of consumer rights for businesses that are monopolies. And the only way I can bring to life the dilemma is, if you imagine the most extreme government on either end of the spectrum, would they come after those mechanisms that are based on the promotion of consumer interests in competitive markets and monopoly markets? It's hard to conceive what that government would look like.
I couldn't possibly comment. My second question is, and this is one that has been raised with me, and this is talking to an experience of a natural disaster, could be the AF8, and the difference between Aurora being owned by private owners versus council in terms of the ability to access government funding as a response to a natural disaster. Would you have any comments about that at all?
No, I couldn't comment on that.
Thank you. Councillor Barker, and then we have Deputy Mayor Lucas, Councillors Gilbert, and then Councillor Houlihan.
Thank you, Mr. Mayor. Kia ora. Just have a few questions. On slide 11, it talked about the non-subsidy, and I just wanted to understand, I guess, in plain English. So does the non-subsidy mean that Dunedin wouldn't be subsidising growth in Central Otago? What people are concerned about is that there's huge investment into Central Otago, and I guess the line charges are lower in Dunedin than Central Otago. So is that what that non-cross subsidisation means?
That's exactly the point.
My next question is just around the deferred revenue on slide 10. So it can't be deferred indefinitely, I'm guessing. So when does the deferred revenue actually get charged and come back to the company, and does the deferred revenue also attract interest?
When there is space under the maximum allowable revenue to include some deferred revenue, it comes back. I don't believe that it accrues interest. I don't believe it accrues interest.
So I'm just questioning about when it comes back, because there's 39 million sitting there, and I guess I'm just trying to understand with the maximum allowable revenue plus all the increased investment, when does that profit come back? I guess some people have sort of said, oh, well, there's $39 million profit sitting in there that has to come back at some stage. So I guess we're just trying to understand the when. Is it in the next 5 years, the next 10 years?
MAFIC will look at the schedule of the return of the deferred revenue. It's a shame that it's called deferred revenue, because it's actually deferred recovery of costs incurred. That's the thing to keep hold of. And you talk about it being other things, nonsense.
what we see is that all of the operational costs have been paid off, etc. So I guess to a lot of people it looks like profit because every year the operational costs are paid, there's some capital, etc. So people are thinking that it looks like profit rather than deferred revenue. Is that a correct assumption around what that money actually is?
That interpretation baffles me. I showed that the right-hand side of the slide, the net profit after tax is available for various purposes, and that's what it's available for. Any return of deferred income has to go through the same process, for example, to pay tax, and then it's available for that hierarchy of allocation on the right-hand side. To earmark it and call it something special, it doesn't seem to me to be a sensible thinking.
Last week we had statements of intent come through from Aurora, and it had profitability going up over the next 3 years to the late 20s to 31%. And I'd asked the question at the time, is there a normal rate of profitability for a lines company, like a expected profit margin or percentage?
Maffick.
Next presenter. Next presenter. Yeah. Okay, thank you. So would it be reasonable to paraphrase deferred revenue as the deferred ability to recover costs? Yep, thank you. Next question is Deputy Mayor Lucas.
Thank you. And just picking up on Councillor Barker's questions about deferred revenue. So at the end of the CPP, the starting point for whatever the next plan does not take into account the deferred revenue that's sitting there, and then the next pricing plan, the base of that, the starting point, does not account for that, to recover that?
We don't know exactly what the transition from a CPP to a DPP is going to look like. There are a number of issues that will have to be dealt with. One of them is deferred revenue. But one thing we do know is that the revenue won't allow for significant disruption to lines charges. So all of these issues under the maximum allowable revenue have to be dealt with at that time.
So then it wouldn't necessarily all come into play immediately, yes. And so then another question that I've been asked is, so are Aurora's prices above or below the national average? And if they're below,
I didn't get the end of that question.
and if they're below, can they request to move to the average, at least?
The whole mechanism has to work in its entirety. It's not a benchmarking of other lines charges in other areas. The only benchmarking that goes on is this idea of what efficient costs would be allowable to provide a safe and reliable network unique to that network and its sub-network areas. So your starting place is where it is, not the prices relative to other network areas.
Thank you. And my last question is in relation, and probably the answer is on this slide, where you talk about Aurora's owner needs to be more resilient in the future going forward, and really it's answering those 8 points as the owner, the ability to that's what you mean in terms of resilience.
Yes.
Thank you. Councillor Gilbert.
Thank you. I've got three questions, I think. The first one is just the deferred revenue or deferred recovery of costs incurred. Is that not... I've always assumed that revenue is recovery of costs incurred, as in the cost side. So I'm just not sure why we're getting hung up on semantics between deferred revenue, which is in and of itself recovery of costs incurred.
Because under this regime, the deferral of the recovery is based on the price impact on consumers. They operate together. The revenue is allowed because that's the revenue required to recover the costs to keep a safe and reliable, or to build a safe and reliable network. The creation of deferred revenue is a function of that tension in the regulated regime.
Thank you. On slide 12, You've got revenue recoverable through lines charges is capped by the Commerce Commission, and the regulations apply to all non-exempt EDB owners. Can you clarify what an exempt EDB owner?
Community owned, directly community owned, with some different provisions around the election of the board. That's not how Aurora and DCHL and DCC is set up.
So are we talking community shareholder? I mean, how does a wholly community-owned EDB look?
There's a direct link for increases in lines charges back to the community, so the profits in the community are closer together than is the case here.
Thank you. And my last one, and further to what Deputy Mayor Lucas was talking about, you mentioned as well that a future Aurora owner, or in the future, an Aurora owner will need to be more resilient and far-sighted, etc. How far-sighted are we looking? Again, this is kind of going back to a question I asked before about the 10-year horizon that we're seeing. How far a horizon is a far-sighted investor going to need to be?
I can't give you a number of years. The simple observation is, and we can see this in a lot of modelling work that we have done, is there's a great deal of risk and uncertainty about the rate at which electrification will occur and the rate at which investment will be required. I've referred a couple of times to the sweet spot between investing fast enough, not too fast, not too slow. And so it may not be a white knuckle ride, but it's certainly over the coming years there will be a lot of uncertainty and risk to be accounted for in getting that sweet spot.
Right. Thank you. Councillor Hulan.
Thank you. Just on the deferred payments again, when we spend, because at the moment, of course, we're in an infrastructure phase where we're spending a lot on Aurora. What can you talk about the impact that has and will have in the future with the deferred payments, please? The fact we're investing a lot now, the assumption is that will come back to us maybe in the form of the deferred payments. Can you talk about that? Because that's something that's been raised.
The return of the deferred revenue has to come under the maximum allowable revenue, which is a function of the rate at which lines charges are increased. The more investment that goes on, the more pressure that puts on the deferred revenue and possibly pushes it out further.
So are you saying that means that the returns will just be spread out longer over more years? Is that what you're saying?
Yes.
Is it fair to say, you may not be able to answer this around value of companies or anything like this, but the more investment we put into Aurora, and the fact we're doing a lot of investment at the moment, some of it obviously we should have done earlier, but that has to be increasing the value of the company, surely?
Surely, but that's outside my brief.
Right, thank you.
All right. Councillor Barker.
Thank you, Mr. Mayor. I'm just going back to the deferred revenue, which is the thing we're all being challenged with understanding. So I'm just reading the Commerce Commission's advice. This is from 2020, but it's talking about the wash-ups. Is the wash-ups where it's been undercharged or overcharged perhaps for a year, and there is, what do they call it, deferred, the wash-up process, and there's an undercharging amount or a actual revenue versus the revenue cap, and then it talks about that there is a time value of money, which they said was a 5% WACC. So that's why I was asking about the interest. Is there a time value added to that deferred revenue? I'm just getting confused between under the CPP and then this is talking also a little bit about the DPP. So I'm just trying to understand those things because they sorry, have you got an answer? Or is that a MAFIC question or is this a regulatory
Yes,
question?
we're going to defer the question,
cool.
or the answer to the question to Mr Thompson.
Thank you. Look, I'm going to try and simplify this because I think we're going around in circles a little bit. we just need to think that this is a regulated business, so the way our revenue is determined each year is quite different from the way you sell stuff in the main street in a shop. It's totally different. And there are two simple components to it. The first is that we're allowed to get a chunk of our revenue based on the costs that we incurred. So that's called just passing through the costs that we incurred. So that's one component of the revenue for any year. And then the second part of it is a return on the amount of the assets that we've built over the years. And you add those two together and that gets what Toby's talking about as the MAR, or the maximum allowable revenue. Now, as we've been trying to restore the assets of the company, what's happened is that the amount of costs that we've been allowed to incur and the amount of the spend that we've incurred, and therefore the return on that, has built a revenue number that we're allowed that's greater than a 10% increase each year. So the Commission said, to the extent that your revenue that we're going to allow you to charge is beyond 10%, we'll put that into a box called deferred revenue. So that's the deferred revenue. So for the period, the CPP period, which ends on FY26, there will be no, or RY26 actually, but small matter, there'll be no further charges. That deferred revenue will continue to increase slightly over that period to 26. Now, that sum is held whole on an MPV basis. So to your point, there's not an interest element, but if it was worth $100 today, it'll be maybe worth $105 in a few years' time. So we're allowed to recover $105 as opposed to the original $100 historically. So that amount is kept whole from an MPV perspective. And then in the next pricing period, which for us will be from 27 to 30, we are able to recover that deferred revenue, and in fact we've got it in our projections. We'll recover that deferred revenue over that period from 27 to 30, which is the next pricing period for us. And so that's already in the projections, and you'll see that when MAFIC present their stuff. That, and then of course we hit the ceiling, say in 27, we put as much in the bucket as we can, and it takes us to 10%, so that uses a bit of it up. 28, we use a bit more of it up, and gradually we use it all through that period. And it gets smoothed, but still subject to the 10% cap. I'm hoping that simplified things a wee bit. So the two elements are totally different from any other business. Our pricing, our revenue's determined completely differently. You've got to think of it differently, and that's what Toby's talked about. Two main components that give rise to it. When it exceeds 10%, it goes in a bucket, and its value is maintained, and you recover it over the next period, subject, of course, to the 10% limit.
Very good. Okay, and Councillor Houlihan, you had a very brief question.
Sorry, going back to the question around the Commerce Commission, a lot of people have raised it. And so I suppose it goes down to the fact, sitting here today, could you guarantee that no future government will ever change that law?
Oh,
of course you can't. You can't, can you? So that's where the uncertainty comes. Yeah.
Oh, that's right. I don't think that was a question. Anyway, look, thank you very much. I think that was a very concise and excellent presentation. Thank you. And so at this stage, because you've given us a gift of time until 11:45, we'll take a 7-minute break till 11:45. So thank you very much. Please, and because we're almost on track. But so we're almost on track. So can we take our seats, please, councillors? Well, I'm talking about councillors O'Malley and Vandevers. Hello. Lee, sorry. Can we just take our seats, please? We can have the... Sorry? So that's even less helpful. Let's press on. So, gentlemen, Greg, would you like to introduce these gentlemen? Thank you.
Question 1 and question 2 hopefully have been addressed to some degree by the separate evidence, which was looking at the regulatory framework in general, which affects the EDB sector. Up next is addressing question number 3. Aurora is a very profitable company, has debt capacity to pay dividends. So we're specifically now looking at Aurora's position. And so evidence will be provided by MAFIC, who will introduce themselves shortly, looking at a number of relevant aspects in relation to Aurora's future, those being its capital requirements, the expected profitability and cash flow generation from Aurora over the next little while, the debt levels and capacity to continue to invest, and then briefly touching on some of the sale considerations. So introducing Vincent Bennett and Campbell Will from MAFIC.
Thank you. Can you hear me all right? Great. So I'm Vincent Bennett, a partner here at MAFIC. And just as a bit of an introduction, MAFIC is a New Zealand financial advisory business, and we focus on the infrastructure and energy space. It's probably worth noting we do a lot of work for local councils and government. And in particular, we last year provided advice to Christchurch City Holdings in relation to their strategic options, and I sort of led the Orion strategic review, so have some good experience with the EDB space for that and beyond. But hopefully, I think the key takeaway there is hopefully we can bring some good context in terms of local and government considerations as well as the private side of things. And Campbell.
Hello everyone, so my name's Campbell Will and I'm a director at MAFIC Partners.
Yes.
So I've spent my career advising infrastructure clients around various aspects, but a large portion of that was spent specialising with electricity distribution businesses and around the regulatory regime that applies to them, so interpretation of the input methodologies, financial modelling around what revenue forecasts may look like under different scenarios, valuations to inform financial reporting and transactions as well, but also I worked with Aurora on its CPP application. And so a little bit of background around the EDB space, and I'm looking forward to the conversation today, so thank you.
Great. So as Greg mentioned, our responsibility or scope was to cover the financial elements of the public consultation. And as we look through it, just a bit further forward. As we look through it, ultimately, I'll just go to the first slide. Really, there's sort of 4 key sections that we're looking to address, and what we'll do is we'll cover them off in turn. But it's probably worth just giving you a bit of context of what we're actually going to go through, so you know what to expect. So the first area we're going to talk through is capital requirements. So providing a bit of context for you as to what actually is the capital requirements over the next 10 years. And in particular, talking a little about the drivers, so you've got some context as to why that forecast is what it is. And a key element of that to get comfort around that is also some benchmarking. So we've done some benchmarking of Aurora's capital expenditure over the next 10 years against its peers and by sort of various categories to get a bit of comfort that it's a reasonable base case for you to use in evaluating what the capital requirements are going forward. The second area is profitability and cash flow generation. So we're going to talk a little bit about the regulation and how it defines the returns you would expect as an EDB. So it's probably a nice continuation on from the last presentation, but looking at it from a returns perspective. And the second area, and I think this is a really critical area we'll spend a bit of time on, is the EDB regulation defines the return you generate on assets. That doesn't necessarily link to shareholder cash flows. And there's a few reasons for that. There's regulatory things, and then there's Aurora specific things. So we're going to just spend a little bit of time there to explain how that link or de-link works, so you've got a better context as to why the forecast sees the additional debt requirements despite that profitability. And then the next area is debt levels and capacities. The unique element of Aurora relative to private EDBs is that it is subject to EDB financial ratios and metrics, but because it's council-owned and consolidated, it is also subject to Dunedin City Council metrics. Those metrics are different, and actually in many ways they have a constraining factor as well, which are important to understand. We'll do some benchmarking against peers, so you've got a good sense of what the current financial risk is. But I think importantly, what we're going to spend a lot of time in is what does that look like over time, and how do those metrics, from Aurora and DCC look. And the last area is sale considerations. So I think the way we've tried to think about this is, rather than saying these are the good things and these are the bad things about a sale, what we're trying to focus on is this is what a sale looks like. If you retain, it comes with these various things, and so I think it's really important to understand that you need to think about it from the individual context rather than just the pros and cons of one. And then there was a question early on about potentially selling less than 100%. Well, what we're going to do too is talk about the various sale options, and there's a handful of different options. They have pros and cons, and we'll talk through what the implications of those are. Now, this slide pack does contain forecasts, so I think for completeness it's really worth just giving you a bit of context around what we've used our forecast. Forecasts change all the time, so it's important that you get a sense of what we're using. And what we've got is we've got 10-year forecasts for Aurora out to 2034. And as I mentioned before, we also need to look at the context for Dunedin City Council, and what we've got is an 8-year forecast for Dunedin City Council. Now, the Aurora forecast is based on a financial model prepared by Aurora Energy for us to utilise. It's based on the 2024 asset management plan, so it's effectively using the most recent public disclosure on capital expenditure and operating expenditure. The other thing to note is we'll talk about this in a bit further, but there's a regulatory weighted average cost of capital, which is effectively the regulatory return that you as an EDB owner get to earn. Now, that changes every 5 years, and just for completeness, what we're using is 7.37%, and that was the rate that was defined in the last disclosure by the Commerce Commission. And that will be the rate we're going to use for the whole forecast. So there is a risk that changes every 5 years, so there is a risk that might change favourably or unfavourably, but we've assumed that continues throughout the forecast. And the other thing, I guess, to note on this is that we're conscious there's obviously a desire to return to dividends, so we felt it was prudent to assume a resumption of dividends over the forecast period. We've assumed 40% of net profit after tax, so a relatively sort of modest amount of dividends, and we assume that returns in FY27. And then the other thing to note beyond those specific forecasts is we understand from Aurora that there is further upward pressure on Aurora expenditure. We haven't taken that into account. We really wanted to focus on using public information, but I think the takeaway there is things do change, so I think it's really important to think about this as where we see it today, but there could be, it's worth being cognizant of how those will evolve, could evolve over time, and we see that as a thing to flag for this. On the Dunedin City Council side, now what we've used is there's two key factors that are important. It's the amount of debt that is required, and it's the amount of revenue that you have to support that. Now, what we've done is ultimately, we've used the 2021 long-term plan. That's the most recent one. It's obviously a little bit old, but it's the most recent. For the debt, we've supplemented it with the latest statement of intent. So that was quite a recent one, and that allows us to get a better sense of what we see in the short term from 2024 to 2027. And then we take the long-term plan additional debt requirements thereafter. On the revenue side, we've used DCC's latest annual plan that was released last week. That informs us what the revenue is in 24 and 25, and then we continue to assume that we have the same growth rate in revenue as per that long-term plan. So I think it's just really important to get that context before we show you what those numbers look like. So the first section is capital requirements. So as has been flagged before, there has been quite a step up in CapEx in the last 5 or 6 years to address past issues. And those issues have largely been addressed. Notwithstanding, the forecast does see Aurora Energy remaining in quite an elevated CapEx level. And there's a few drivers for that, which I've touched on this slide here. You can see that. I will talk through those in the next slide, but these are probably the 4 key ones of note. And then in terms of benchmarking, so the forecast we see is $1.1 billion of CapEx. When we compare it to peers, it's effectively right in the middle. We sort of feel like it's a good benchmark. There are some plus and minuses on an individual category basis, which we'll talk through. So this slide here, the graph provides what is the CapEx over the next 10 years. So the dark blue line is historicals, and the sort of this shaded line is what we see in the future. So what you see is a slight an increase over time. I think the thing to note is what we've presented here is on a nominal basis. So i.e. there is inflation embedded into this. In the full report, we'll also show you a slide where we adjust for inflation, because I think one of the messages, you do see a slight increase, but actually when you adjust for inflation, it's a bit more flat. So you can have a look at that when we provide you that report. What are the key drivers? The first one is CapEx inflation. So we're all facing inflation. It's a theme beyond the EDB sector, but it's also worth noting that the CapEx for this sector has been well above CPI. So equipment has grown at a faster rate, and we have seen additional costs for things like health and safety. So embedded in the forecast is those costs that have come through. So that's driving across the board additional CapEx requirements for the sector. Now there is a number of assets that need to be replaced in the forecast. This is obviously business as usual. Various assets need to be replaced, but there is quite a meaningful amount of CapEx that is required to replace certain assets. We've flagged the fact that Central Otago and Queenstown is a high growth catchment, so it does have additional growth requirements. And the final area is decarbonisation and climate change resilience. So, CapEx to support the electrification of energy, and then also CapEx to actually make sure that the whole network is resilient to climatic change events. And that is a theme throughout the EDB sector. It's probably worth noting that we think there could possibly be risks, and it's flagged in the asset management plan that there's a bit of uncertainty as to how much that will actually be over time. Now, if I go to the next slide, what we've done here is we've looked at the 10 largest EDBs, and just to explain what this graph is trying to do is, obviously we need to normalise this expenditure by the asset base. So effectively what this is over the next 5 years, how much CapEx is required relative to the asset base today, or what we call RAB today. So you can see Aurora is spending effectively 70% of its asset base for the next 5 years on a nominal basis, again, to be clear. And that's very similar, actually, to peers. So it gave us a bit of comfort. what we have in the full report is we have done there's various subcategories, and we've done a comparison on each of those categories. And I think the things to note, and you can see that in that right-hand side, the arrows, the red basically means that Aurora is slightly less than peers, green arrow upwards is more. So the things to flag is Aurora probably has more asset replacement renewals required. That's just a function of the age of the assets at the time. And so it's got a bit more expenditure than peers there, but it does have less reliability, safety and environment capex relative to peers, and also it has a slightly lower inflation forecast. So those are probably just two things to note, but as I said, we're focusing on the one forecast for this piece. Yep.
Great, so in this next section we'll just talk to a slight carry on from the previous session around the return on assets and how that regulatory regime is constructed and how that can differ from what cash flow is actually available to the shareholder. And so as you've heard today, the regulatory regime is set up such that Aurora will earn a return by design, and it's a return in line with that regulatory return. And that's expected to be achieved over the long run. However, in the short term, that actual return can differ, and there's a number of different factors which we'll talk to around the things driving that. But that essentially focuses around the revenue or the top line of the money coming into the business, and then there's a question of what can come out the bottom with the shareholder cash flows or distributions, or what's available. And over the forecast period, we're currently seeing a negative $220 million cash outflow. So that is before distributions, and that needs to be funded by capital. And in Aurora's instance, without access to equity, that means borrowing. So this slide here is just talking to that first point around the returns that Aurora can earn. And so there's been made the point around earning that regulatory return in the long run. And in the right-hand graph there, we're showing what that regulatory return has looked like over the past 3 regulatory periods. So it's that flat line that steps down. And it's set for a 5-year period, which is why it's flat. The revenues for that regulatory period are set at the start of the regulatory period, and therefore how you actually perform thereafter that setting of the revenue can derive the bars, which are the actual return that Aurora has earned. That regulatory return is sensitive to a number of things, but the major one is the risk-free rate, and it's stepped down over the last decade due to a number of economic factors, and you can see it dropping down there, and Aurora's returns and the sector's returns have followed that. And going forward, as Vincent spoke to, it's expected to go back up to around the 7%. The underperformance in the historical period up to 2021 is a result of a number of factors, but the more material one there, you can see where it drops away in 2018 is a function of one, the revenues being set back in 2016 and them being locked in for that regulatory period, but then secondly, the increase in capital expenditure increased the asset base and therefore resulted in that equation of essentially returns over asset base, the denominator getting bigger and that number getting smaller. In the last couple of years, Aurora has outperformed the regulatory return, and that's a function of the revenue wash-ups, deferred revenues that have been spoken to, some financial incentives and things in place. However, and you can see here that so the performance can be below and above the regulatory return in the short term. However, over the longer term, we would expect to see returns in line with the regulatory return. So just going into a little bit more detail around why those things can differ. And this is a slightly simplified view, but one of the key components of it is when your allowable revenue is set, there's an adjustment in there for the revaluation of your asset base. And what that does is it reduces the amount of cash or revenue that you can recover today, and it pushes it into the future. That's an NPV neutral but it does mean that you have less cash today. The second side of it is that there are other adjustments. So there's, for example, the smoothing of revenue within a regulatory period. So that was the X factor that was referred to earlier. And then there is also the revenue wash-up account, which has also been discussed. Again, these are MPV neutral, but they defer revenue to later. And then there are other adjustments that starts to get a little bit into the detail, which I won't go into. So that essentially, again, sets that what Aurora can charge in terms of its prices. And then there's a question of what is available in terms of cash for distributions to the Dunedin City Council as shareholder. And again, there are a number of things here around tax and interest costs and differences, but the most material one for Aurora, given its stage, is how its capital expenditure compares to the regulatory depreciation allowance. So the discussion earlier was around that building blocks methodology for setting your revenue. One of those building blocks is the regulatory depreciation. So that's how you recover what you spend over time. But up front, you have to pay for the capital expenditure. So you need that cash going out the door today, and then you recover it over time, over the life of the asset, and that can be up to 70 years. And that difference between that graph on the right-hand side, between those two bars, needs to be funded by capital. And again, in Aurora's instance, that's debt.
And I think just to emphasise this, there's always going to be a bit of a mismatch because capital expenditure is going to grow by things like inflation. But because Aurora has spent a significant amount of capital expenditure over the last few years, and that's going to take up to 70 years to recover, Aurora is in a bit of a unique position, and that's why you see such a big, stark difference. You wouldn't necessarily see the same difference for other EDBs, and I think that's just a key thing to note.
Sorry,
Yeah.
just questions at the end.
I'll just go through it again just one more time, just to be clear. So what we're saying is the light blue line is the amount of depreciation you get to recover and charge. The dark blue line is actually how much money you have to spend on additional capital expenditure. You can see it's a significant difference. That's driving this difference between your profit and the amount of cash you have at the end of the day to pay to shareholders. A big reason for that is that depreciation is spread over a long period of time, up to 70 years. Aurora has spent a lot of money in the last 5 years to catch up. That is going to be earned over, say, 70 years. But because of that, and because the CapEx remains elevated, what you're seeing is a much higher capital need relative to what you get to earn back. Yeah.
So here we've talked to the profitability and then that cash flow. So on the left-hand side, we're showing the net profit after tax. And that highlights the point that Aurora is a profitable business. And again, nobody's arguing with that point. The profit is also forecast to grow off the back of the growing revenue profile as well. If it would be helpful, we have a slide in the appendix as well around the deferred revenue that was mentioned earlier, which we can come back to at the end if there are further questions. But the revenue, that recovery of that deferred revenue is in that forecast, just to be clear. On the right-hand side, though, this is where we translate to the free cash flow that is available to the shareholder. And we're showing large negative amounts driven by the large capital program. And so before discussing distributions, there is a negative $220 million in the current forecast, and that would be paid for by borrowings. There isn't a current position around distributions from Aurora, and so we've made an assumption, as mentioned earlier, around the 40% of net profit after tax, starting in financial year 27. And so that's shown there as the light blue on top of the graph. And so that's an additional $150 million that's included in the forecast for a total of $370 million of additional borrowing. So the next section talks to the debt levels and the capacity to borrow that money. And as Vincent mentioned, there are different credit metrics that apply to Aurora and then being owned and then the Dunedin City Council. And by virtue of the ownership, those Dunedin City Council metrics at the group level also apply to Aurora. The key metric for electricity distribution businesses is the funds from operations to debt, which is a cash before capex to debt metric, versus the one that you'll be more familiar with, which is the debt to revenue metric. And I've already spoken to the capital requirements there, but we'll go through that in a little bit more detail. The note that we expand on here is what that means for the Dunedin City Council and your borrowing as a group. And in the forecast that we've included, that goes to over $2 billion by FY31 from the current $1.2 billion. And then the final point just to note is around the need to support Aurora should you continue to own it, as mentioned earlier in another presentation, around the risks of underinvestment, which you'll be very familiar with, and the potential for penalties and incentives and things to come into place. So having a business that has quite different credit metrics to the council means that there's a sort of few different factors here that we've sort of tried to summarise. On the left, we have the Aurora Energy relevant metrics, and this is particularly around the credit rating agencies. If Aurora was to have a private rating and borrow on its own name, for example, and that's particularly focused around that FFO to debt, but they also look at other variations around debt to EBITDA, debt to RAB, interest cover and things. But that differs to the metrics on the right-hand side around, which is relatively consistent across external rating agencies, the rating for or the internal limits for the council, but also LGFA. They all look at the debt to revenue metric. They just look at it in slightly different ways. For this, we focused around the S&P one for the council, given it is the more imminent one with their recent assessment of a negative outlook for the council. So on the Aurora side, there's the different thresholds apply around how leveraged you have, or the entity sits, or where they are. And when you're at the more highly leveraged end of that, so the darker red, this is where it creates a greater risk for the shareholder. And then on the council side, on the right, in their methodology that S&P apply, they do have a threshold around that 240%. However, they also have discretion as you approach that limit to also modify another part of that ratings assessment, which relates to the financial management. So it's not necessarily wait until you get to 240% before a ratings impact takes place. It could happen in advance of that. So to provide some context, we've shown how Aurora Energy compares in terms of its leverage relative to other EDBs in the New Zealand sector. And there's a range of ownership in New Zealand. There's a conversation earlier around the consumer trusts ownership, but the majority are owned by consumer trusts or local governments. And the ones there are a couple that are privately listed or privately held. So here we're showing the FFO to debt and the debt to RAB. So for FFO to debt, the top graph, when you're over to the right-hand side, this is where you're more highly leveraged. And on the debt to RAB, when you're over on the left-hand side, again, more highly leveraged. And you can see for both metrics, Aurora is off to the more highly leveraged end, and it's sitting next to the likes of Vector, Powerco, Wellington Electricity, which are privately held or listed companies. The key difference for these businesses is that they have access to capital either by issuing shares or their fund owners being able to access more capital to inject into the business, in addition to also borrowing. The takeaway here, though, is that Aurora is at the more highly leveraged end. And then looking at how that changes over time, the first couple of graphs are just showing those two ratios over time, and they stay relatively in that highly leveraged space. The perhaps more interesting one is on the right-hand side, which is around the DCC group debt to revenue. And in the forecast, this is suggesting that DCC supporting that borrowing program from Aurora puts pressure on the council to maintain or stay under that 240% threshold. And there's always going to be that potential for a ratings downgrade that you should be aware of. So this is the constraint that was referred to of Aurora Energy being within the council group. It has implications that it may not be able to borrow to the same extent that it otherwise could. And Aurora's, on a standalone basis, has a debt to revenue of around 370% at the moment. And that's significantly higher than the 240 line, or where the blue line currently is on that right-hand graph. So what that means is, as a group, the council has to have lower leveraged assets elsewhere, or your other business units can't borrow as much because Aurora requires that borrowing. So you have to manage it as a group.
Great. Okay, so so the last section here is about sale options and comparing that to retain. So this first slide is what we've done is just a really simple side-by-side look at some of the considerations, I guess financial considerations of retain versus sale. I'll walk through this. I'm conscious there may be questions, so happy to address them in more detail where there's greater interest. But if I go through them, the first area is valuation. If you retain, the value of this asset will be the book value, which is ultimately the RAB. That RAB obviously increases over time as you spend more money into it, but it obviously is less debt because you've got debt to fund that as well. And I guess the consideration which has been touched on before is that, by contrast, a sale option, recent metrics in Australia and New Zealand help support the fact that a premium to that book value could be achieved. So there is that opportunity to get a cash generation above what that book value looks like. Now, the other key concept is under a retain option, as DCC and councillors, there is a requirement to commit that additional capital to maintain the network. That is something that will need to be funded and accepted to be able to deliver that, and that obviously has implications on the various credit metrics that Campbell presented. And I think our takeaway on the DCC access to debt and credit quality, what we showed is that the EDB itself, it remains relatively, while it's highly levered, it remains sort of within the bands. But the key issue is that DCC group level credit metrics, and it is trending towards 240. So there is increased risk as a council, but also less resiliency. And I think that's also a key thing to consider. The sale option obviously is the flip side, in the sense that that will deliver the capital, and I guess a full sale or balance sheet separation does remove that 370% debt to revenue from that metric, and that gives you, I guess, headroom to manage future risks. From the dividends perspective, as we've shown, there is dividends in that forecast, because obviously we recognise that's important to DCC, but it is debt funded, so that's just the thing to note. Now, by function, as Campbell said, the cash flow, the return that we've been talking about, that return on WACC, some of it gets deferred to capital gains, some of it is actually cash. So one of the considerations is that potentially with a sale, if there is capital reinvested into other assets, there is an opportunity to deploy some capital into assets that are more cash flow generating. That might be more sort of suitable for your desires to generate consistent dividends. Obviously, control of EDB infrastructure. naturally retained is self-explanatory in terms of that. But I think the thing I would stress on a sale side is the regulatory framework does mitigate risk. And a few things to touch on is that any capital that's spent into a EDB, you generate a return on it, and so obviously there's the right level of incentives to continue to invest in a network. And the same thing is, and it's the same for quality as well. There's various quality metrics which we won't go into detail here, but effectively you are rewarded for doing a good job and penalised for doing a bad job. So that's another sort of mitigant relative to other potential sectors. And then finally on that is really that revenue is capped. It's already capped today, based on the maximum allowed revenue that was discussed previously. So it's a bit different to a non-regulated sector asset in that respect. And the last area, again, has been covered, but Aurora is a large portion of the total asset base. So it is a concentrated risk. And, there is sort of obviously merits to considering diversification of risk. Now, next slide, we discuss sale options. So this covers a question previously. What we've shown is that if we work our way through on the columns, status quo is the retained, and then we look at a minority sale, i.e. a transaction where you sell less than 50%. The next is a majority sale. You don't sell it outright, but you sell more than 50%. The fourth is a full sale, and the last one is a partial network sale. So what I mean by that partial network sale, that's an example where maybe you sell a subset of your network. For example, Centro Otago, you might sell that and retain the rest of the existing network. And then what we've colour-coded them really just into three high-level buckets: low, medium, and high. High obviously being favourable. And then on the x-axis, what we've got is we've focused on what we think are probably the 5 key financial considerations. One is value maximisation. So the question there is, does that transaction lead to an increase in maximise the value? So effectively that's kind of answering the question around that premium to RAB or premium to book value. Execution risk. Now that really talks about the uncertainty of actually delivering. So to have a successful transaction, you need it to be, you need to minimise the complications. You need to have the right investor appetite, and a few other things, but those are probably the two ones I'll talk about. The next is DCHL control. So obviously DCHL has control via governance and as the shareholder. So hopefully that's self-explanatory. And then DCC credit quality goes back to that discussion. How does the transaction mitigate your credit quality? And then finally is value-adding ownership. This is obviously not really relevant for a status quo or a full sale, but where you have the other categories, in theory there could be additional value from having a shareholder or from the new structure to you as the residual shareholder. And I'm happy to address a few of these in points, but I think the things I would note here is the view here is that, or our view is that 100% sale delivers the maximum value, so the maximum premium to RAB. And there's a few reasons for that. The first is really the size. The total asset base of the business is actually quite attractive from an investor perspective, and we would expect a number of investors to be attracted to committing the time and effort into diligencing an asset for that size. Where it gets a bit smaller, the pool becomes more limited, and so we think that's actually quite attractive at the current 100%. And the second is control. So we would expect any incoming investor to have a discount if they can't fully control the business. And if you think about it, that's things like, where they're able to own 100%, they can manage their balance sheet, the debt, and they can, they're not sort of subject to dividend requirements of the other investor or things like that. So that kind of is another reason why we think the 100% would deliver the greatest value. The second is on execution risk. I think there's two things to note. Again, we sort of see the full sale as the most deliverable, partly because it should attract quite a wide range of investors. But with a less than 100% sale, there comes governance considerations. Obviously, you'd need to negotiate a shareholders agreement. What does that look like? What rights does DCHL have, and so on. So it comes with a little bit more uncertainty. And then on a partial network sale, the one challenge there is that there is complexities with asset separations. These assets aren't naturally separated, and so there would be work required to actually cleanly separate those two businesses, which comes with time and complexities. The DCH control is pretty self-explanatory, but I think the thing to note is that if you were to undertake a majority sale, the incoming investor there will be negotiations around what shareholder rights they have as well. DCC credit quality, this sort of addresses a question earlier. The challenge with the minority sale is we've already talked about the fact that there's less of a premium to RAB, so you're not necessarily getting as much additional cash above the balance sheet. But the problem too comes is that you don't necessarily get balance sheet separation as well. And so that obviously is a complicated matter in itself. But if you do a minority sale, there is still consolidation considerations. So that debt to revenue still becomes a impediment to the overall DCC credit quality, in addition to the fact that there's less proceeds. And it's a similar sort of story for partial network sale as well. And then the final thing, value-adding ownership. I think the thing I would note, and we've got another slide on this as well, is that one of the challenges with a partial network sale is that ultimately, if you retain a subset of the business, what you've got is an asset that has less scale. So more costs over a fixed cost over a similar customer base, and there comes with operational challenges. So I think when we think about what would be the value of the asset thereafter, that is a consideration. It's not necessarily one for one. There is some additional sort of issues, I guess, to consider. And the last area, and I know there was a few questions on this, is really just to talk a little bit about this partial network sale as an option. And I think obviously we've talked on that previous slide, one of the key benefits of it is the fact that it enables DCC to retain potentially assets that are more valuable for various reasons. But we just really wanted to stress the considerations that you need to take into account if such a transaction was contemplated. And the first area I've talked about is that because of the smaller size, there is likely to be a reduced investor set and also potential valuation implications. The other thing to note is that with a smaller business, there is, and less scale, you have to be conscious of the fact that there is considerations around for the residual business, can you access staff, what is your contracting negotiating power, and some considerations around actually what that business is going to look like after. But I think I also want to stress is that we've talked a lot about, in general, this decarbonisation trend, this climate change resilience, but beyond that there is technological things going on in the sector, smart grids, more intermittent generation coming into the network. So it's quite important as a EDB to enable providing a quality service that you have the right scale to have the right people and the investment to actually manage that. So that is a consideration as well with a situation and becoming more subscale. And the other area is really just the fact that EDBs have fixed cost base. There's variable bits, but there is fixed costs that needs to be recovered. So ultimately, that would need to be recovered over a smaller customer base, which could have revenue per customer implications. I've talked about the complexities of splitting a business, but I think also just to note, while you can sell a residual business, the debt to revenue of the existing business that's retained still is expected to be at that high level. We talked about the 370% debt to revenue. Obviously, that still remains a drag on the residual business, albeit I would say it's smaller. So that is a positive, but it doesn't necessarily completely remove a higher debt to revenue asset from the wider DCC credit metrics. So that's that. Oh, I've got conclusions too. Yeah. Look, just really recapping, and I'll go through this pretty quickly because I'm conscious there will be questions, but as we've said, the capital requirements, we think it's going to remain elevated. There's some supporting evidence around drivers and peers to support that. From a profitability perspective, because it's regulated, it is going to generate a return on assets. That is a function of the business. It's obviously a positive element of the business. That does not translate to shallow cash flows over the next 10 years. There's various reasons for that, but the one I want to sort of emphasise is the fact that because of the significant capital spend, there's less depreciation recovery versus the cash you need to spend to going forward. So as a result, we are forecasting negative free cash flows over the full 10 years. What does that mean? Well, that means additional debt required, and it also means additional, it does have implications on your credit ratios. Our message probably is that from an EDB perspective, over the next 10 years, it's highly leveraged, but still achievable. It's going to improve, it's forecast to improve slightly. The key issue is that DCC credit debt to revenue metric. That is shown to have a drag over time, and that's the one I think is important to consider. And then the last thing is, I think with sale considerations, I've talked about that, so I might just leave that one for questions.
All right. So you're saying we'll move to questions now?
Yep.
I have a couple to start. Page 12, the graphs on page 12, the last two bars on the right, you talked about the Aurora's outperforming at that stage, which does show a benefit on this graph. But of course, it's true to say that you cannot realise that increased performance because that is a deferred income. So in fact, that's an increased cost to the business. Whilst it might look good on the graph, that cost is deferred some time off.
This one here is showing your returns in your information disclosure, which is your the revenue that you have charged.
Yes.
So it is the revenue from those years.
All right. So what does that mean in 22 and 23? Aurora had increased revenues.
So yeah, I mean, what that is showing is that prior to that, the returns were below what you should be getting from a regulatory perspective, and that's a function of the various complexities. Deferred revenues is one example of that, but there are various other things. For example, the capex requirements were more than what was assumed in that 5-year period. What we're saying is that in RY 22 and 23, those historical periods, there was outperformance, and that was effectively in some ways a function of that deferred revenue getting a benefit in those years. And what we would say is you do see, we expect to see a slight improvement as well above that return in the next few years. So there is a short-term benefit for that. In the long term, ultimately your return is going to be a function of WACC. So that, and what we've got a slide which we can probably go to. What that does see is if we, and again, it's not just the deferred revenue, but the deferred revenue does get used up over the full 10 years. So by the end of the 10 years, that deferred revenue bucket that was talked about is reduced to zero.
Over this next 10 years.
Should we put that slide up? Actually, it's probably worth it.
So the table in the bottom left corner there is showing that revenue wash up, or the deferred revenue balance, and you can see it's growing at the moment, but it's forecast to be recovered over the regulatory period ending RY 30. So the revenue profile there is growing over there, and so part of that is additional revenues from the current asset base and return on that. and part of that is recovery of those deferred revenues, so it's included in the forecast period.
Right, I was just struggling to reconcile that with the graph on page 13, which shows the cash capex is significantly higher than the regulatory depreciation allowance, which it looks like about another 20 years beyond that, so about 30 years out before those two graphs converge.
So what are you sorry, just to clarify, you're asking this slide, if I go back to, oh, sorry, how do I go back? Oh.
13.
Is there a way to make that back on?
13, page 13.
Yeah, oh, there we go. Yeah, we're good. Yeah, so you're talking about that right-hand slide?
Yes, yeah.
So this isn't deferred revenue. This is, so deferred revenue is another, that is what we discussed just then. This here is depreciation versus cash capex. And you're right, that's, you can see if you were to extrapolate that, and we haven't done a forecast beyond it, but you know, you can see that there still is some time required for those to converge.
Right. Okay. But that's an interesting graph that in the 10 years you think that will converge. Steve. Mr. Thompson.
Thank you. I'm going to try and simplify this. Basically, you'll see that we spent a lot of money in the years 18 to 22, which we didn't get paid for, and we're picking that money up now in the next period, and that's why we're above the standard return that we would expect. So we're just picking up the revenue from overspending that we didn't get the money for in the previous regulatory period, and those lumps there are making up for it. And so
you're talking 22 and 23.
Yeah, 22 and 23 are just picking up extra revenue from the spend that occurred in earlier periods. That's all that's showing. Simple as that.
Right. Very good. Okay, thank you. We have a question from Councillor Vandevers, followed by Councillors Gilbert and O'Malley, and Parker and Wiley.
Thank you very much. I think from what you've said, it's quite clear that if we're going to sell, it's got to be the 100%, and you've given good reasons for that. You've talked about, in the event that we keep it, that we're looking at least 10 years of ongoing increases in debt. What has been your forecast assumption regarding interest rates, given that I'm old enough to remember paying 14 and 22% back in 1982?
Yeah, so I think there's two elements to that. So from a DCC perspective, a lot of the debt has already been hedged, and I won't talk to that. It's probably best for someone else to explain that, but I guess the comment is that there is quite a bit of mitigation that's already reflected in this. From an Aurora perspective, what we've assumed is that the risk-free rate, or the government bond rate, is that is what's embedded into that 7.34% regulatory WACC. So we assume, and that's effectively, I think it's about 4.5% from memory. So that we assume 4.5% throughout the 10-year period. Now, obviously, there is risk to that after the 5 years, but we think it's the right assumption to assume it's flat through there.
In the event that it's not flat, and say instead of 4.5 we go to 10 or 14, given then that we've got a planned extra 350 million of debt just in Aurora, surely that is got to be, even though the chances might be small, the effect of that would be financially catastrophic, would it not?
So there's a couple of sort of comments there. Yes, ultimately the thing for an EDB is that their returns are a function, not only as interest rate, but their returns are a function of it. But I think the thing to note is that one benefit of an EDB is it is slightly hedged, in the sense that what you can see here, if we go to the net profit graph on this side, and you see it's increasing, a reason for that is it's getting the benefit of the higher interest rate. So that does slightly offset it. Where you probably have an issue is what happens over the next DPP period, because actually if interest rates do fall, and I think there's probably some merit for us in this long report to provide a few sensitivities, because I'm sort of talking to this without kind of running them, but if the interest rates fall, the allowable revenue and the allowable profit actually reduces, so that could actually be a negative outcome. So because you've just got less cash that gets generated within Aurora. So that's actually probably a bit of an observation, which is a bit unique in the sense that most people think about higher interest rates actually being a negative. This could actually be the other way around.
So just to simplify my understanding, if there were significant changes in interest rates and we kept Aurora, they wouldn't necessarily be catastrophic given that it's a regulated environment.
Yeah, I mean, it's more hedged. The issue is possibly the rate of change could impact your revenue side for Aurora. Rather that's the big risk. And so, yeah, is that answering your question enough? Yeah.
Righto. Councillor Gilbert.
Thank you, and thank you, gentlemen. I've got a few questions. First of all, on page... first of all, some of the slides that you were showing don't appear to have... We stop at page 25, and you were at least on page 35.
Yeah, correct. Yeah, we just focused on the content we were talking, but if needed, we'll include it in the full report, though.
Cool, thank you, because, yeah, needed. Thank you. So on page, I believe it's page 8, yes, you're referring to CapEx forecasts and CapEx requirements, etc. I guess I'm just getting, and you may be able to tell from my previous questions, I'm getting a little frustrated with us waxing lyrical about how an investor will look at it and go, for the long term, this is a really good investment, etc. But we're still sitting at a 10-year horizon, and the 10-year horizon here looks to, at least at the very worst, plateau. It even looks to that the CapEx starts to drop at that point. So what happens after that is a big question mark. Any soothsaying prognostication you wish to extend past 10 years?
So I think I can't comment on what's going to happen after the next 10 years. I think if we look at the drivers, you probably got to assume things like decarbonisation and climate change resilience are probably going to be a continued trend. It ultimately is, though, going to be driven by the ageing of assets. So when those assets need to be replaced. The other thing to kind of note is one observation is we still see the depreciation being materially below the cash CapEx. So it's hard to see that kind of, it's probably reasonable to assume that that's going to continue at least for a little bit longer. And yeah, I mean, that's probably my two key observations with that.
I'm not sure whether this is the presentation that can answer it, though, but surely despite having however many years of underinvestment or under maintenance, bad English, at some point we have to get to a point where everything is then up to scratch. So surely at that point, it's a far lower maintenance CapEx.
So I think and I think this should be also answered in other questions, but other sections. But I guess what we'd actually say is the CapEx has already been spent to address those issues. So that is actually a past issue. Where we are today is we're not saying we're necessarily recovering all that underinvestment. That has happened. And now we are standing here today and saying, what is our CapEx going forward? So this is in some ways the norm. This is what we've got. And you look at all those inputs. CapEx inflation is not a historical thing. That is just the fact that we have had more inflation, so costs are going to be more over time. High growth in Central Otago, Queenstown, that's not really that relevant there as well. And then the replacement of those assets, what we're saying is the reality is assets need to be replaced all the time. There's a little bit of movement from time to time, so there will be fluctuations, and I can't really talk to that. But that asset replacement I'm talking about is just normal business as usual. All EDBs have to replace assets, and there's some cyclicality to it.
And I think my last question is on, what are we, page 23. It's around the partial network sale, and you mentioned just before about the growth in Central and Queenstown, etc. And it's got that it would have less of a reduce the investor pool, etc. And there's also been commentary that EDBs, we can't look at an EDB the way we look at it, if you like, a normal business. But if you're looking at a normal business and there's an area of massive potential growth, that is what you say. I mean, if you've got two outlets, one you've got massive potential growth on, that's the one you're gonna try and sell if you're not going to sell the whole thing. So I'm just curious as to whether we can look at it similarly, whether because on one hand we're saying there's a lot of growth, a lot of potential, etc. in Central, and then on the other hand we're saying, yeah, but we can't. Yeah, there's not going to be quite the same interest if we sell parts of it, and I'm finding that hard to gel.
Yeah, no, I get that. So to sort of address that point about, you know, high growth means higher value, that is a lesser extent for an EDB, but it is still relevant. So I think you'd expect that a higher growth EDB should attract, you know, a higher value versus a lower growth. I think that's fair. But the difference is that ultimately all you're doing is earning more return on RAB. So you're generating return on spend. So you're basically spending more today and generating that 7.4% return. It's not like you necessarily have the same kind of additional growth margins you'd get by expanding a business as you would for an ordinary business. So I think that's probably one thing to flag, and as a result, it's not going to be as material, but it will be more positive. I think the thing I would sort of flag though is that, you know, if you look at Central Otago and Queenstown, the RAB's about 380 million. These businesses, if you can see for those private sectors, they're leveraged to sort of circa 70% debt to RAB. So we're sort of talking, if you do the maths, we're talking about a, you know, less than $100 million equity business. As a general rule, a lot of international investors will want to be deploying more capital in that. And so my point is that actually Aurora is relatively unique in the sense that Aurora's equity check is going to be more attractive to a wider range of investors. And that's why we feel like there's going to be more competition and competitive dynamics in a full sale versus a Central Otago sale.
Great, thank you. Councillor O'Malley.
Got a couple of questions. One is around our debt limit and our relationship to the LGFA covenant. Having spoken to LGFA, found that we were the only city in the country to have that covenant, and it was largely put down to that our Treasury sits inside DCHL, to which obviously there's two fixes there, is can Treasury move out of DCHL and we get out of that covenant? Because I went to a LGNZ infrastructure conference 2 weeks ago in Wellington, and Tauranga presented its debt. And they are massively more in debt than we are. So, and they have gone to basically a vehicle mechanism to do balance sheet separation, but they are already capped out at their LGFA limit, and then their secondary debt's coming up to it as well. But apparently they're not breaking the covenant. And so one of my issues is how much is the covenant itself contributing to the issue here? Because if there is a remedy there, that could be something we could pursue.
Yeah, it's and jump in, Campbell, after if I missed anything. But the metric we have been really focused on is actually the S&P metric, not the LGFA, because I agree, and that's why we've actually completely ignored it in the slide. You can see we haven't presented it, because ultimately with the LGFA metric, there is an ability to not need to look at the debt and revenue of the subsidiaries. So to your point, agreed, that's in theory something you could mitigate, but that's not the issue we're addressing. We're just addressing the S&P credit rating metrics. and that there does include all subsidiaries. And so that's the key constraint we're talking about. Is there anything you want to add there?
The only other point would probably around the difference in the credit rating for Tauranga versus Dunedin City Council. So Tauranga is, I think, currently sitting at an A+, which is lower than Dunedin City Council, the AA. So Dunedin City Council has a stronger credit rating in S&P's view, reflecting that borrowing and also the financial management of the council.
No, thank you for that answer. And I guess what I'm getting at there is S&P has going around, especially, and I think in the background we've got to put Three Waters into the background here, and S&P's commentary and association with councils over the last year or so. It's been going around most of the councils and pretty much saying you're going to get down-regulated because of your Three Waters. And so what about the fact that if all the councils end up getting down-regulated, and in fact, as you just pointed out, there are councils who are in worse trouble than us, surely, is the government, I mean, it's an open-ended question for the room, really, not for you to answer. How's the government going to respond when everybody gets down-regulated and all of our interest rates go through the roof?
And you're right that S&P has flagged across the country the institutional framework settings. So they look at the basically legislation that you work under, the tools that you have to recover revenue, and so forth, and they put the whole country on a negative watch for that component of the rating. Some councils were able to manage that adjustment within their headroom in their rating, but that was when the likes of Dunedin was put onto negative watch as opposed to stable for their rating. So S&P has flagged, and they've, as you say, they've tied that to things around government policy, perhaps not progressing as quickly as things like Three Waters was a key consideration.
My other question is into the split model, split sale concept. And I want to start out first, back up on Tairāwhiti and the, I think it's called First Light Network, I think is. So that did sell, right? And was that considered a particularly good sale?
I think it was perceived, well, I mean, I don't want to comment too much on that, but it was an attractive sale, I think. Like, there was competition, and I don't have too much privy into how much competition there is, but clearly there was an investor or investors that wanted to buy that asset to get a foothold into New Zealand EDP space.
So, just going off population statistics you can get online, basically the population of Central Otago is 73,000 compared to the 130,000 of Dunedin. So my first question would be, I assume based on those population distributions that the Dunedin network is actually the bigger part of the Aurora network, is that correct? And is it true that, I think it's PowerNet, is it? Otago, basically, not PowerNet.
PowerCo.
Otago one, just surrounds us. OtagoNet, yeah. Is it true that OtagoNet, do we have lines that run through the OtagoNet system that go to, so we're not physically connected? Thank you. So I guess my question is, if a population of 49,000, which is the Gisborne regional area, had a network that was big enough to be attractive to be bought, why would a population of 73,000, which is the CODCQ or DC area, not have a population at a size big enough to be attractive?
No, I think, just to stress, we're not saying you're not going to be able to sell it. It's just if we look at where the types of investors and the competition, a full Aurora sale is a more attractive proposition to a wider range of investors. So when we had that graph, we were looking at various things. One of them was value maximisation, and we feel reasonably comfortable that value maximisation is achieved for a 100% sale, and it's lower for a partial sale or a partial sale of the network.
I mean, it makes sense, but I'm also taking a perspective that I don't know. I mean, honestly, I don't know anything about electricity because it hasn't been in the council for a few years, but I'm quite familiar with a lot of the underlying theories around Three Waters. And one of the issues is you don't really get a huge amount. If your networks are quite literally separated, then it's very hard to achieve, except at the administrative level and head office, achieve the efficiencies because your networks are not actually touching. So I guess where I'm going here is, I think it would be obvious to anybody that if you were to break the network up and sell off one part of it, you were not going to get, if it was 30% of your size, you're not going to get 30%, but you might get 25%, right? And the size and attractiveness is really going to depend on where you actually are quite literally working together, or where in fact your networks are actually separated and you've actually got a competitor in the middle in terms of your physical connections. So when you say it's less attractive, do you mean that proportion could get 90%, 80%, or 75% of what you would get it if it was attached to the whole thing?
I mean, it's a really hard one to say. We'd be confident there'd be a discount, and there'd be more transaction uncertainty as well because of the fact that there's the complexity. So I probably can't comment too much on that, exactly what that percentage is, but I'm probably stressing it's the pricing and the certainty as well.
I will finish after this one. So base of the population of CODC is about half as Dunedin's. Is it true to say that roughly the CODC, QLDC section is about 1/3 and then 2/3 are in the Dunedin area? Or Dunedin is a lot smaller because it's older?
Yes, Mr. Thompson.
In terms of RAB value, regulated asset base value, which is how we generate our revenue, Dunedin's 47% of the total. Queenstown's about 20% and Central Otago 33%.
Largely reflects that because there's been so much new growth going there that they have a higher RAB value. Is that what it is, the capital value, or just?
It's more complex than that. Central Otago, for example, was a very dispersed network requiring significant spend on assets compared with the number of ICPs there. So yeah, it's not straightforward.
The same problem with Three Waters too.
Rightio. We're going to be struggling to make 1 o'clock, that's for sure. Councillor Barker.
Thank you, Mr. Mayor. My questions may appear random, but I wrote them through the presentation. Just one of the feedback that people was giving me is that the assets for Aurora were mostly built, say, 50 to 70 years ago, and are we hitting a lump in investment that then when will the capex drop because of the age of the assets? So one of the theories is that it will be like a lump of investment. So would that be true?
I think there is always going to be some lumpiness, but I would probably stress, I'm just going back to this slide here, right? To ask, if you compare it to peers, are we spending significantly more or less? In the full report, we can show you what it was for the last 5 years, and I can tell you the last 5 years was significantly higher. It was right at the top. If we look at the next 5 years and the 5 years after, I mean, you can see that it's bang on the middle. So I wouldn't say there's some silver bullet that we're going to necessarily revert to some normal. I think that kind of shows you kind of where it's at.
Okay, my next question is, given that one of the key issues is the DCC debt, and that most distribution companies in New Zealand are owned by community-owned energy trusts, could it be assumed that this is the preferred ownership model, given also that this would get Aurora off the council's books?
In terms of preferences, I think it's more a function of the way that it was set up during the electricity reforms rather than a current day preference, but it's a little bit up to each individual in terms of how they prefer to hold their assets. There are ways to achieve financial or balance sheet separation, but it's slightly more complex in terms of how you can separate those assets out.
So the DCC could still have an option to put it into a community trust if it so chose?
I mean, maybe in theory, but we haven't done the work to really evaluate that.
My next question is on slide 21, and it just talks about the asset base, Aurora's percentage of the asset base, and it's at 54% in that slide. It's just that we've heard verbally 70% of the asset base and 66% from DCHL, so I just want is your figure based on a different valuation from DCHL?
As a key takeaway, I think we should probably just confirm how each of us got it. What I can say how we calculate that 54% is we went through the annual report, picked up the book value, and just for the subsidiaries, and then that's how we calculated the ratio. That was based, I think, on FY23 accounts, but it's probably worth us just making sure we're aligned.
I just want to confirm they are different. So book value, and we use the last valuation, so market valuation as of FY21.
21, so there's a difference in the S, given that we're in 2024, so that's why the difference? Okay.
No, that's not the reason for the difference between the value that we've talked about and the value that Mafic's talked about. They have used book value, we've used market value. Our market value is stale because it was 2021, and I think I made the point in the introduction that if we updated that valuation as of today, our expectation is that Aurora would be greater than 67 or 70%. But we can clarify the basis for that and what our expectation of what it looks like today in follow-on information.
Yeah, I guess it's just useful to know there's a good bit of disparity there. So on slide 21 also, I guess, did it mention the factors such, it was a little down the bottom, factors such as the cost of capital impact the valuation, and I just wanted to understand, or was around the high interest rates in relationship with the interest rates impacting the, where was it, this may not persist item, and there's a little asterisk 1, and it goes down the bottom and just talks about the relationship of interest rates. So is that basically the return on investment compared to what the interest rates are now, because they're sort of high in New Zealand? Are we talking in a worldwide market or in a New Zealand market?
Yeah, so the point there, and we share actually the same feedback as I think Greg mentioned, in that we have a good sense of what the value could be today. We don't really know how it's going to evolve. So the point of that bullet point was really just emphasising there are a whole host of factors that could change. Cost of capital is one, and so the point there is that the return on asset is 7.4% today, and anyone that's going to be investing today will be able to, because of higher interest rates, they can earn higher interest rates on other investments. So it's not to say that it's a 1-for-1, i.e. if interest rates go down, the value is going to go down proportionally. But that change in interest rates and the change in sentiment can have an impact on value, particularly if it's very volatile. So our point is that the interest rates could change. The second point, though, to note is that the types of investors have their own return requirements. The return requirements they have today is actually quite attractive for this sector. They like these kinds of assets, but that could change. Infrastructure investors might want to target higher return assets or various other things, and the sentiment might change. So our point is that it's a combination of both those things.
My next question was around the forecasting of the new connections. I'm not quite sure what slide that in. So it says that there was a forecast of 1,400 new connections, and I've got two questions about that. Is the assumption that they're happening in Central Otago? And I just go back to, because I did make a sheet of all of the connections. So last year there was 1,000 new connections. The year before that 1,100. The year before that 1,200. So the connections might appear to be slowing down, possibly, given the last 4 years. So where did the 1,400 connections come from? Is this based on central growth?
Yeah, so what we've used is the asset management plan. So we wanted to make sure we were independent, took a public view, so we didn't take that view. When I looked at it, I thought it was actually very similar. Like, I thought historicals might have been around that level, but I might be wrong. But it might be worth just clarifying it in the next section around exactly how that forecast was built up.
Yeah, I just want to understand, because it's based on 400% difference, I guess, if you've got 1,000 and then you're basing it on 1,400. So I just wondered, whoopsie-daisy, how that might impact on some of the figures. So I guess I'll just leave that with you, because it was a baseline assumption. And just on number 7, it said that there was an upside risk to the base case, and I don't understand what upside risk means.
Sorry. So what I mean by upside risk is is basically more higher capex risk. So there appears to be risk of more spend than what our base case is.
And I just have a question about how does the decarbonisation affect CapEx? So I know that there are some power companies or lines companies or whatever it's run. No, maybe that's. So just give me a little bit more information on how decarbonisation actually affects the CapEx. Is it more for us down here in the south, or?
So it's really what we mean by decarbonisation is primarily the electrification of energy. So it's electric vehicles, and obviously electric vehicles just ultimately means there's going to be peak demands. You need to have the capacity and build out to manage that. And secondly, the other is electrification of industry. So, the farming industry might be converting diesel boilers into electricity. There's a lot of push to do that. So what I would say is the areas that are more urban and the areas that have more industry that need that conversion are going to be the areas that will probably have more decarbonisation CapEx.
Cool, just needed to understand it. And then I just, what slide was that? 5 was you used the DCC's revenue growth from the 21 to 31 LTP and you put in some, used our annual plan, which was a 17.5% rates increase. So did you, what growth rate did you use? Because I mean, we've got our revenue is capped at 6%, but obviously that's not happening, given our investment in Three Waters, etc. So which number did you use for the growth rate after this annual plan?
Yeah, so I think in the full report, and we should probably jot this down, is we can probably provide an appendix slide just to provide some supporting evidence on that. But we used the growth rate in the LTP, which I think is low single-digit growth. But I think the thing I would stress is that what we tried to, we thought about, can we extrapolate that, but then we need to extrapolate the debt as well. So rather than trying to increase the debt requirements, say, and compensating it with more revenue, we just focused on the LTP and kept consistent so that the numerator and the denominator were using the same base.
Because we have been putting our depreciation on our debt for the last few years since the LTP was written, so I just wonder whether that just needs to be factored in a little bit. We've been running unbalanced budgets, so perhaps it's just to get those underlying figures, so we do have some strong stuff to...
Yeah, I'll talk to Greg and just make sure we're at least not missing anything that might be relevant.
Very good. Councillor Wiley.
Thank you. Can I please get clarification from somebody, whether it's you both or Mr. Thompson? I'm just looking at slide 7, capital requirements, key observations. Aurora Energy is forecasting capex of 1.1 billion over financial year 25 to 34. Yet when we go to statement of intent from last week, which we signed off under the dividend policy, we are planning to invest in excess of 900 million in the network over the next decade. And I'm trying to get clarification because is it 900 or is it 1.1 billion? Obviously there's a difference in figures there, and I'm probably looking more to Mr. Thompson on that one.
Yes, both numbers are correct. The 1.1 million is the gross value of capital spend, and the 900 is the net of consumer contributions towards that capital spend.
Okay, so you can see the problem that we have as elected members versus not understanding the industry and trying to work out apples for apples to get clarity. So the next question, and to me, this is the one I've struggled with most. What is the value of Aurora?
I don't know yet.
There is a book value of what it is, and so if you Google it, it comes up. In 2020, it was worth, total assets were 617 million. Is it still 617 million? Is it 800 million? What is the asset value of Aurora right now?
Yeah, so I could go down a few different tangents, but are you able to maybe elaborate what you're trying to sort of get out of that?
Yeah, well, say it's 800 million. We're then being informed that this is going to be a capital hungry company. It needs 1.1 billion. So if we've got an entity that's today worth, say, asset value of 800 million, we're then going to look over the next decade to put 1.1 billion. So essentially we're building the asset, we're increasing the asset value. So at minimum it should be worth 1.9 billion plus. But obviously because it's going to have greater growth and opportunities. So I'm struggling to see where that is in the projections we've received to date.
Yeah. So the RAB today is, call it around $800 million. We would expect in a sale to get a premium to that. Let's call it 1.4 times, and maybe it's $1 billion, let's say, round numbers. So that's kind of where maybe a sale scenario is. Now, to answer your question on, okay, we've got $800 million, $800 million today, 1.1 billion is going into it. To answer that, there's a couple of points. You have to spend that $1 billion to get there. So ultimately, you don't get free money for that. That is actually ultimately the amount you have to spend. So in the full report, we could probably show you what the RAB looks like over time, but it's but ultimately the value, why people potentially pay a slight premium is that there is a desire to invest more capital and generate a return over time, and that's often why they can get an additional, but you can potentially get a premium over the book value today. The other thing to note is your business RAB is not going to be 800 million plus 1.1 billion, because there's a few considerations, and without going into detail, there's the capital contributions, which brings it down, and which is basically a straight pass-through. You have depreciation, and so as a result, your RAB will go up, but it's not a case of 800 plus 1.1. And we could probably show you what that RAB forecast looks like, so you know what it looks like.
Okay. Then on top of that, I guess there is no pathway. We can't go back to say, look, in 2004, if we followed the same trajectory or anything along those lines, there's no pathways like that we can follow to say in 20, 30, 40 years' time, this potentially is what it looks like. Because, again, you've got to put yourselves in our shoes. We're trying to make a decision here for the community. All the data I'm seeing right now is only giving me 10-year data. I'm trying to think, what is this going to look like in 30, 40 years' time? Yeah.
Yeah. So I think in theory, you could hold this asset for 10 years, 20 years, and there would be a value ascribed to it at that point in time. The opportunity cost for you is really two things. One is that what we're flagging is the credit rating is getting worse. And that's obviously a really important thing to think about as the counterfactual, because as Greg mentioned, these assets are illiquid and you don't know what they're going to be like over time. So that's a real risk you need to consider. The second thing is that it's not, when you sell that asset, and you will, that we're saying you could sell it at a premium, that cash can be used to reduce your debt, and it can also be used to redeploy into other assets. And so for you, it's also important to think, do I want to own an asset that has the profiles of an EDB, which is stable, but has quite a non-cash element to it and has a big capex requirement? Or do I want to own assets that have a profile that better suits me, which maybe you might want a higher distribution, you may want to be diversified, but ultimately you can't compare owning an asset to a zero. You need to compare it to what the counterfactual is. And I think there is a section that talks about what those options are, but the reality is all assets generate a return. Aurora is probably on the lower risk, lower return end, and there's other assets all the way through. So I think it's really important to consider that as well.
Thank you. All right. Look, I think we need to cover off our various questions. We've got two more questions, Councillor Elan and then Councillor Gary.
Thank you. Right. So just Yeah, on that, there's so many different answers that we haven't. But say, for example, we're going through an infrastructure stage at the moment, and you haven't, I don't think in your information you've given a scenario where we don't get a dividend at all, and we look at a certain period of years where we don't take a dividend to get through this tough time, and then so that we can keep the asset and the money goes back into the asset for investment and clear a bit of debt. What does that scenario look like, please?
Yeah, I think it's really important to understand that you need, when it comes to DCC metrics, you do need to think about it on a consolidated basis. So if you get a dividend from Aurora, that is going to mean more debt for Aurora, but it's going to mean less debt or revenue for DCC. So there isn't necessarily a free lunch. The reason you might reduce your dividends for Aurora, there's a whole host of reasons, but it often is because of your EDB related financial risk metrics. But the fundamental issue is actually the DCC financial risk metrics, which are consolidated. So it sort of doesn't actually necessarily impact it on a consolidated basis. The other thing to note is there is obviously, I understand, a desire to have dividends. So you also need to think about it. You know, we would need to reforecast things based on what you're actually wanting as well.
Well, the feedback we've had from the public overwhelmingly is that they want us to keep this this investment. So, and many of them have said we don't mind, you know, if you don't take a dividend for a while to keep this, you know, going over this infrastructure stage. So are you saying if we don't take a dividend, surely going back to that scenario again, if we don't take a dividend, that must be better for Aurora because it means they've got more money to invest and more money to put into debt. Is that not fair to say, or are you saying that's not the case?
So what I'm saying is you need to get revenue from somewhere, right? You can charge higher rates, you can get dividends or whatever. So what I'm saying is that you need to get it in some form. If you get it from, or you borrow at the DCC level. Now, to take a simple example, let's say that Aurora pays a $10 million dividend. If you don't pay that $10 million dividend, you have a funding gap at the DCC level. So you can either charge higher rates, $10 million higher rates, or you can borrow at the DCC level another $10 million. Right. So,
however, once we get through that difficult stage, this is what we're all asking, is that surely our returns from Aurora should be a lot better. And it sounds like, but what you're saying is that that will be constrained because of the Commerce Commission only allowing us a certain amount all the time, even, and that goes back to, just to clarify that, around the growth in that industry with EVs and the growth in Central. You're saying even though we've got that huge growth, that for any normal business that's great, you're saying in this situation, is that because of the Commerce Commission we're set at this level so we'll always get just that type of return? Is that what you're saying?
So on that part there, ultimately you get so your asset base will be slightly bigger because you've spent money into it, but you'll still get the same return on that asset base.
But will that mean the deferred payments, because we've paid in a lot more, we'll get a lot more back? So those jumps we had in 22 and 23 on that graph, we've got those coming up, another big injection eventually, haven't we? Is that fair to say?
So we had a slide a bit further which showed you the deferred revenues profile, and that does reduce to zero over the forecast. So they are a bit separate in the sense that yes, you're spending more money, but you actually do ultimately recover it because it's capped at 10% per year, and so yes, you've got more capex, but actually you've got enough leadway to be able to recover those deferred revenues as well as needing to earn more because you've got a bigger asset base. Is that, you want to add anything to that?
Councillor Geary.
Asked and answered.
Great. Okay, gentlemen, thank you very much. My goodness, there's a lot of facts and figures there for us to digest, and even more in the slides to come. Mr. Anderson, did you have something you wanted to say?
I'm just conscious of timetable, Mr. Mayor.
Yes. Well, we certainly need a break.
We had allowed for half an hour. Would that still suffice if we were to return?
Yes,
at 2?
I think you'll go till 2 o'clock. Yeah, have a lunch break now until 2 o'clock.
Great.
So we're just going to move the program back half an hour.
Thank you.
And we'll try and,
Catch up.
try and catch up. We did catch up a little, but I'm sure there'll be a lot of questions for Mr. Holdham. Anyway. So we reconvene at 2 o'clock, please, promptly. We're off. So, no, 2. Okay, so welcome back, everyone. So we're running slightly behind time already, but I know Neil's very precise and concise. So I'm very pleased to welcome Neil Holdham here, who has lots of fascinating real-life information to talk to us about and corresponding presentation. So, take it away, Neil. Or at least you were going to have an introduction, were you, Greg?
I was just going to mention, thank you, Mr Mayor, that there's been a slight change in the order, obviously. We need to get Neil out of town. And so he is going to start post-lunch, and then we'll hear from Stephen Richard from Aurora after that. Also wanted to note that the presentations are available publicly on the DCC website. But with that, we are up to point 4 on our agenda. Feedback from the consultation, some suggesting that the sale of Aurora would be or might represent a one-off cash gain and the benefits would be short-lived. We thought we'd address this in 2 ways, but firstly, with hearing the experience from someone that's been there and done that in terms of the divestment of an EDB. So with no further ado, over to Neil.
And you just have to push the button on your microphone. Bring it nice and close.
Excellent.
Can I ask on our slides, is this council investment strategies and implications, is that one?
Correct.
Thank you.
So, tēnā koutou katoa, ngā mihi nui. Hi everyone, I'm Neil and I bring with you greetings from the humble village of New Plymouth. Delighted to be here. So, in 2004, New Plymouth District Council sold its cornerstone shareholding in an NZS ex-listed electricity lines and gas pipe business, Powerco, and it started what has been a 20-year process of investment strategy refinements on a path to maturity. Look, I'll start by talking about our perpetual investment fund as it is now. And I suppose there are a range of models across New Zealand, and I'll talk to some of them later on in the presentation, but the New Plymouth model is considered to be fairly high up on the maturity scale after that 20 years. So the key elements, and I apologise for the 3-letter acronyms, we're good at them in council, so MPDC is New Plymouth District Council. But the model, it starts with a council-controlled organisation, a CCO, and in this case it's got a fully independent board. So there are 4 members of the board, and they are investment professionals, and they are known as the PIF Guardians, and they oversee the fund, and then they have appointed, and it's within their power to appoint, a fully outsourced agent, which is Mercer. So essentially Mercer takes its instructions through the statement of investment performance and objectives, and then they are supported by investment managers who make the actual investments. So the fund has a diversified portfolio based on, as I said, the SIPO, the Statement of Investment Policies and Objectives. The structure has been developed in a way that those assets sit inside the council balance sheet, and they underpin our AA+ credit rating from S&P. We don't pay tax as a non-tax-paying entity. There is one of the key elements of the model is a governance deed, and within that governance deed, and the report will provide all of these documents to you, they're all public record, but one of the critical elements within the governance deed is a requirement that to make a change to the governance deed requires a 75% plus vote of council, a supermajority, and the support of the PIF Guardians. So in other words, should someone, and I have colleagues that often talk about wanting to access the capital base of the PIF to perhaps give people a 0 rate increase 1 year or something, they would have to they have to get the support of the PIF Guardians and 75% of their colleagues. There's also an Act of Parliament that we went to Wellington last year, looking at the risk of amalgamations, but also wanting to just increase the intergenerational protection of the fund. And so we went to Wellington and asked them to take a local bill, which is called the New Plymouth District Council Perpetual Investment Fund Bill. Sorry, we're not that exciting. But what that does is geofences the benefits to the existing New Plymouth District Council boundaries. So, for instance, if Taranaki was to be amalgamated into one council to rule them all, the financial benefits of the PIF are geofenced to the current boundaries, and it also just adds, there are a few lines in there about the perpetual nature of the fund. But I'll make the following point. The fund does provide a level of self-insurance. So at one stage I proposed putting it into a community trust, and the advice I received is that we would lose the halo effect of our credit rating, because if we put it into a trust it would no longer be a New Plymouth District Council asset. That would lead to a credit downgrade and increased borrowing costs, and it would also mean that we wouldn't have access to those dividends. So I had a model in mind, but the advice came back actually the model we have. So under the PIF bill, there is a scenario where New Plymouth District Council could call on that capital, and we've defined it as an extreme event, and that is for us the primary risk is we live on the side of quite a large volcano, and so the anticipation is that the model of dividends is protected, but should 75% of the council and the PIF guardians determine that a capital release is a prudent thing to do, i.e. after an extreme event, there is that ability to draw on that. And what that does is has an impact on our insurance costs as well and brings them down. So look, this is, sorry, I'm probably a little small, but I'm hoping you've got them on your screens. But this just is, so every quarter our PIF guardians come and present to council. So we had the meeting with them last week. We've got a CCO's committee, and they just report on the fund's performance. And as you can see there's a summary of the performance. The goal in terms of the release is that it trends towards 3.3% of the value of the fund. And if you look at, fundamentally what the statement of investment performance and objectives are, is that the fund should earn in real terms more than 3.3%, i.e. 3.3% over and above the rate of inflation. And you can see the performance there, and there's a bit of volatility, as you'll know. Post-COVID, we had some ups and downs, but overall the performance has been in line with our expectations. And with the release, the dividend policy, the PIF pays a quarterly instalment to council, or they can, depending on what the finance team's requirements, move that around somewhat. So it's just a matter of sometimes we don't need the money, and so we'll leave it in the PIF. When we do, we just draw on it. But as you can see, the kind of returns, so for us it's sort of 11.5 million in the last 12 months. This is, I suppose, this is a graph that's got your, your returns on the left-hand axis, and then the kind of risk volatility, and you can see the PIF where it sits there. So we're an intergenerational fund where the goal of the PIF, and when you see the statement of investment policy and objectives, there's about 20% of the portfolio is in bonds and cash, with 80% in equity markets. So it's designed in a way that it can continue to provide the steady returns, but also enjoy the benefits of growth. And you can see where they've put the PIF, which is that kind of bluey green spot up there, which just reflects the beliefs. And the guardians, I mean, their fundamental belief is that you can't beat the market, and that you should be in the market in a diversified way that reflects your appetite for risk, and spread across. And in the details of the report, it goes through the you can see kind of where they're invested and the approach to ensuring the fund is diversified, and there are ranges in there because obviously as your equities move, the percentage that they represent of your overall investment move, but the goal is to be a fully diversified fund. So some more three-letter acronyms, just in terms of PowerCo, which is still head office located in New Plymouth. And just for complete transparency, I used to work there, and I was actually working there when it was sold. And so the current owners are QIC, which is the Queensland State Government Pension Fund, and Dexus, which you probably know as AMP Capital. And AMP Capital have merged with Dexus and rebranded themselves. So essentially you've got two investment funds that are the shareholders of PowerCo. So what have the outcomes been in terms of New Plymouth District Council sold that asset? And so I suppose a key summary, one, the staff numbers have increased by a factor of about 100% over the last 20 years. Two, so shortly after the GFC, the shareholders, they had a bond that came up for replacement, and instead of going out to the market and replacing that bond, they made a $100 million capital injection in the business to support the increased capex that the business had forecast. Here's another three-letter acronym, but I think you're aware of this. So around 2016, I was actually part of the PowerCo's team that we went to the Commerce Commission and applied for a customised price path to increase, and you well know this, the revenue that we could charge to support a $1.27 billion capex program to really to get ahead of some of the network decline that you're familiar with. Look, I thought I'd talk about international investment expertise. So when the Queensland State Pension Fund bought PowerCo, we were a business, so they bought a shareholding off Babcock & Brown, were the people that bought it from the council. And we'd been through a rapid period of growth, and we had a fantastic CEO, Steve Bolton, who was he was a mergers and acquisitions guy. And we'd been a listed company, quite dynamic, and the QIC sent some kind of auditors over, and they shuffled through the business, and the summary was they came back and they said, you're a little bit fast and a little bit loose, and you're a little bit light on corporate. And so what they did was they actually gave us a greater OPEX allowance at a corporate level, and said, right, you need to go away, and we want to see an increase in risk management functions. We want to see an increase in your legal requirement functions and an increased focus on your regulatory risk. So they basically looked at us and said, we're happy to forego some returns over the next few years, but we need you to tidy up. And so as a result, we hired quite a lot of staff. At that stage, a colleague of mine was on parental leave, so for my sins, I picked up risk management and technical regulatory compliance, which are two thrilling areas to manage. And so, but we hired, and it also included the environmental risk management. So we hired a couple of amazing, talented young people, and really the business matured significantly in the way that we approached risk. And I think that came from international directors looking at the business and saying, we're a long-term investor because we're representing these people's superannuation funds, and we've got a lower appetite for risk than you do, and we want to align the business. So not only did they put their money in, but they also bolstered up the organisation. The organisation obviously runs a range of community kind of engagements and sponsorships across the country. And then through the customised price path, we significantly invested in the systems and processes to allow us to deliver for the customers. We considered as a business that we needed to do a better job. And I've got that image of this Powerco outage porthole, which was a project that I delivered with actually there's a Christchurch business that does data visualization so that we could actually communicate outage data in real time to customers. So that system is hardwired into the outage management system within the business. So to do that, we had to upgrade the SCADA, which is all of your data coming in from the field, then update the management system that actually operates that, and then hardwire that into a customer interface so that people could see both real-time unplanned outages as well as planned outages. So that's improved customers' access to information. Traditionally, they used to just get on the phone, wait for a long time, and someone would answer it and then have to look it up in the system. You'd be familiar with the key metrics for these companies is the nature of network performance. How many outages do you have a year? How long are those outages? So Powerco's maintained stable network performance over the last 20 years. And the qualification is that there is an allowance for extreme weather events. So obviously when you have things like Cyclone Gabrielle, where the roads are gone, etc., and the Commerce Commission allows for those exceptions. There's been significant network investment, and within the report you'll see the investments over the sort of past decade and then what's forecast over the coming decade. And they've also ramped up their environmental and social governance works, so that they are actually following kind of international best practice. And then with my New Plymouth mayoral hat on, they've also made, as well as hiring a whole bunch more people, they've made significant investments in their head office, and they've built 2 new control rooms and upgraded their offices so to expand to accommodate the growth. So look, I just thought I'd talk about the operating environment that we're all in, and I've got a long-term plan to sign off on the 4th of July, American Independence Day. Our council has put through a 12% increase this year. It would have been 18%, but we've had a significant organisational restructure, and we've managed to pull $10 million of operating expenditure out of the business. So we would have been sitting at about 18, but the average for our long-term plan is around 8%. And my understanding across the entire sector is that that local government is sitting at an average of 16% year 1, and then around 8 to 8.5% for years 2 to 10. And I'm not sure if you've seen the Infometrics report, but it is available to local government, and it's in the appendices of the report. Just pointing to, the three most material feeders into this situation are the price of delivering capex, the price of the OPEX implications for council, and then the increased borrowing costs, which have all come together to drive the kind of conversations that we've seen had all over the country, where there was a time when a double-digit rate increase was considered quite extraordinary, whereas now it's pretty much par for the course. And so as a result, we are seeing councils across the country reviewing their investment strategies. I've been talking with some of them and looking to support these longer term infrastructure strategies. And look, New Plymouth District Council's having conversations with its neighbours about Three Waters and how we might do that. And I'll share with you a comment from a colleague of mine, Mark Hall, who's an engineer and leads our Three Waters teams. Think about your LTPs when you think about your CapEx profiles. This is my 3rd LTP, and every LTP, the level of capital expenditure climbs, and it doesn't climb by a small factor, it climbs significantly. Now, I'm doing quite a lot of work in decarbonisation because I do a bit of work in the energy sector. The journey that New Zealand is going on in terms of decarbonisation is going to be much more capital intensive a lot earlier than many people think. And particularly our reliance on fossil fuels is obviously an issue, and there's a lot less of it now because of the government policy settings. But as you can see, that these inputs are really driving councils to go, you're looking at every possible lever that you can pull on as you're looking at rates essentially across the country doubling every 8 years. So what's going on? So you've probably seen some of these conversations play out in newspapers and on the media, but so we'll start with the first Auckland example. So this was Auckland's 23-24 annual plan. You'll be aware the Mayor proposed a full sale of the airport shares. They went through a process of consultation and they made the determination to do a partial sale, and they used that to pay down debt. So, and that was 836 million. Part two of Auckland was the LTP, and that was signed off on Thursday last week. So, and look, it's all covered in far more detail, but in a nutshell, they proposed the sale of the additional airport shares, which I think are valued at about 1.3 billion, as well as this idea of leasing the port assets to a third party for a period of 30 years to secure an increase in returns. Now, where they've ended up is they have agreed to sell the airport shares, and the port company and the Mayor and the unions have done a deal whereby they're not going to lease the port, but the port has agreed to increase its dividends to exceed the expectations of what they would have got from a lease to a third party. So the lease has declined, but the dividends will increase. The Bay of Plenty Regional Council, so they're a major shareholder in Port of Tauranga, and their proposal was, in a nutshell, to sell down their majority shareholding stake to 28%, to a minimum of 28%. So they've been through that process, and they have determined to sell down those shares with a view that they're diversifying their risk, and they can increase the returns available to them through that process. And so then the Christchurch City Council, the Christchurch City Council Holdings Company proposed to the council to be able to undertake active portfolio management, which is the ability to sell shares or businesses within the portfolio to meet council requirements for cash flows. They were preparing to take that to public consultation in their LTP, but during the deliberations in December on what would go out for public consultation, the Christchurch City Council chose not to publicly consult, and so essentially have just parked that and made a determination that they may revisit that at a later date. But the advice from management was it was too complicated and too much to do as part of their LTP. So they've set back from that. And then Wellington, and I believe this happened on Thursday, their proposal, they're owner of 34% of the Wellington Airport shares, have proposed to take their airport shareholding to market. The drivers for them are somewhat different. A lot of it's to do with their uninsured risk exposure. Be aware, I'm not sure what your insurance premiums have been doing here. Our insurance premiums in New Plymouth have been climbing at about 20% per annum. Wellington's obviously with its seismic risk and quite a lot of their properties exposed to sea level rise as well. Their insurance costs are climbing at around 30%, and their other primary assets are a range of buildings in Wellington. So they've got a significant exposure, uninsured costs. And so what they are proposing was to sell their airport shares and create a perpetual investment fund. And that they're basically proceeding to market, so they're going to test the market. What I would also just add to both the Bay of Plenty and Auckland examples. So Auckland, Mayor Brown is proposing with the airport the 1.3 billion they hope to get from the airport to create what's called the Auckland Future Fund. And if you note, I had a chat with Wayne about the New Plymouth District Council Perpetual Investment Fund Bill, and sitting within the documentation that was signed off last Thursday is what looks incredibly familiar, but it's called the Draft Auckland Future Fund Bill. And I think with Bay of Plenty, they're also proposing to create some sort of, they've already got a vehicle, which is Quayside Holdings, which is their version of DCHL. But they're essentially looking to create a perpetual diversified investment fund. So what we have is Auckland, Wellington and Bay of Plenty all considering exactly the same things you are considering. Christchurch also considering that, but determined not to proceed. So I was told to be concise, but I'm happy to take any questions.
Yes, so our first question is Councillor Gary.
Thank you, Mr Mayor. Thank you, Neil. That was excellent and a very relevant example. I just wondered for clarity, if you could just explain, now I picked up the 2004 New Plymouth District Council sold the power and gas utilities and now it's Powerco, and so we heard that. In terms of where you fit in, you worked for Powerco and then you got elected to council? Yes. And then you became the mayor. And you have a consultancy.
Yeah, so look, so Powerco's head office is in New Plymouth District Council buildings. Up until recently, they've relocated to their primary site in New Plymouth, which is just up the road. So it's a long story short, but I used to go running with lots of engineers and told them how we were renovating all of these electricity networks across the country, and they mentioned to me that council was doing the opposite to its water networks. So in 2016 I stood for council. Someone suggested that I should also run for the mayoralty because it's good for profile, and I accidentally became the mayor straight away. So yeah, and that I had to resign from, as my wife said, having a proper job. No disrespect, Mr Mayor. And from
Powerco, you mean?
And yeah, so I resigned from Powerco, but at that stage I set up a consultancy and I work in my weekends and spare time for the energy sector.
Just thought that was important for clarity for the community. And my second question is around the slide, and I think it's slide 6, which is the Powerco slide with the outcomes following sale. That's the one that was just up there, that one. That tells us about all the positives. What about, are there any downsides?
As somebody that worked there, I don't think there were, and I think I heard people talking about like regulatory, you know, the risk of the regulations not being in place in the future or things. I think the issue of ownership is quite interesting when you come to regulated businesses in terms of what is the ownership, like how do you get to articulate your ownership. So I'll give you a good example of, we bought our half of the airport off the government because they're terrible people to be in business with. They're a lazy shareholder and they never invest. So we wanted to invest. So we purchased our share of the airport and we've built a new terminal. We've created another CCO, and it's a fantastic asset now and delivering really well. And about to actually, we're going to build a solar farm together. And that it's a strategic investment, and we have the ability to kind of appoint directors and we lend them all their money, and we have significant control. In terms of if we were still a shareholder in Powerco, we have no ability really to control it because they're controlled by the regulator. So, I mean, from my perspective, the changes, I think the downside was not related to Powerco. It was early on in the fund. It didn't have the structure that we have now. That structure was put in place in 2017 after I came in. So traditionally there was Taranaki Investment Management. They weren't diversified, and actually they ended up heavily invested in Tasmanian dairy farms, and when the GFC hit, they didn't cut their dividends. They didn't have a really clear dividend policy, and so the council's approach to managing those investments was not good. And I think that whatever your processes and whatever decisions you make, please put in place protections that avoid you getting into a situation where they were heavily invested in a dairying farm operation which required significant capex, but as a shareholder had no ability to fund that CapEx requirement.
Thank you for that, because that has been something the community has been concerned about. Thank you.
Very good. Deputy Mayor Lucas.
Thank you. What was the community's view back at the time when the council were selling their shares in Powerco, and then now what's their view today?
So I think that from my understanding it was probably not dissimilar to the views that you've heard articulate. There was a lot of concern around what was the driver, and concern that it would have been a mistake. I think now, in terms of the view of the perpetual investment fund is seen in Taranaki and New Plymouth as a taonga. It's something, and I think we talk about investing for current and future generations. Fundamentally, that's why I'm in the role. I've got 3 youngish children, and I think it's really important. And what I think works well with the perpetual investment fund now is that, so it pays its 11.5 million, and that's growing dividend each year. So that equates to about a 5 or 6% discount to rates. And we actually put it in as a line item on the rates so that you can see, and we call it the perpetual investment fund rebate. But it's also growing, and it's a fund that will, because my view is those are not our assets, it's wealth that's been passed on from past generations. But what we've done is safeguard it as best we can. And just as an aside, we're actually, through our latest LTP, because insurance costs are one of the big risks for us, the pain, and I'm not a big fan of the insurance sector. I hope some of them are listening. So what we've actually looked to do is as our fund grows, we retain the existing dividend to offset people's existing rates as it is, but the growth in that dividend, we're actually allocating to a bunch of basically self-insurance reserves. We've got a severe event reserve, and a climate resilience reserve. So essentially we are using that to grow our self-insurance with a view that we as an organisation are going to have some, we are looking at what levels of self-insurance we take on, because right now I think we spend about 3 million a year in insurance, and we can see that compounding at 20% per annum, and it's not sustainable. So we're looking at how can we offset some of that risk, knowing that we're not actuaries. And it is, you're betting against the house. But so the PIF is certainly well regarded by the community, and they realise the importance of it. And we went out to public consultation when we did the New Plymouth District Council Perpetual Investment Fund bill, and there was widespread support from the community for those additional protections.
Excellent, thank you. And my last question, some of our submissions have been the concern about the head office would leave the city, and obviously the jobs that go with that, but that hasn't been the case and was never going to be the case? No, so just...
It's a quirk of... so Powerco's head office was actually in the New Plymouth District Council, so when I got my job as mayor I had to move a whole floor. But the main site is just up the road at Junction Street, so it's about 4 kilometres away. What's happened in the last couple of years is they've consolidated, so they're all in the one site. And as I say, they've invested around 30 million in that site, so all of the offices in there, it's quite a lot bigger now. It's actually a full campus because they've got around double the staff. And so it remains, and then they've got other offices around the country.
So they've got other other assets around the country?
Yes, so I think...
You've got the one down south.
Yeah, so there's an office in Tauranga, there's an office in Palmerston North, and there's an office in Wellington, because they've got gas networks, electricity networks, and as you can see, they're not all connected as well. The Tauranga or eastern assets are actually sort of, they're not physically connected, but the whole thing is run as an integrated business.
Great. Councillor O'Malley.
Neil, thanks for coming. So is the purple Powerco?
Yes.
I'm just trying to read the map.
Areas where they own both electricity and gas.
Yeah. And now gas in the green area, is it?
Sorry, electricity in the green areas and gas in the blue areas. Yeah, sorry. So purple is electricity and gas, green is just electricity, and blue is just gas.
And obviously that's a lot bigger than when New Plymouth sold its share, I assume?
It's exactly the same.
Oh, okay. So, because I've got the 2018 PowerCo annual report, and it says it has valuation total assets of 2.3 billion and paid 56.8 million in dividends. So is this the same entity that your PIF fund has come from?
Yes.
And your PIF fund is worth 376 million and pays 12 million in assets, and paid 12 million in dividends this year?
Correct. When PowerCo talks about their asset base, what they're not, they'll also, you need to look at their debt levels as well.
I'm actually looking at the dividend though, because that presumably is what they felt they could pay. And in 2018, they report in their annual report, they paid 56 million. So my question is, are you confident that your PIF has kept up with the asset accretion value of the PowerCo valuation itself, and so that maybe in 2008 their dividends were quite small compared to what your PIF could give you, but it seems to me now that what your PIF can deliver and what they are given in dividends is quite literally 5 times apart.
Yeah, and you're exactly right, and I think I made the point that what happened with when the council exited PowerCo, they didn't put in place a diversified fund. They didn't put in place any protections. They paid significantly higher dividends through the period of the GFC than they should, and it led to a significant erosion in the value of the asset. And as a result, I think about $115 million was lost in asset value during the GFC. And that's why when I came in, essentially they'd just exited, because their primary asset was a bunch of Tasmanian dairy farms that had no ability to pay dividends. So they cashed those up in 2016, and that I got elected just after that. And then so we came out with, I think, 300 million, and then we put in place the protections that we have now to ensure that that would never happen again.
Thanks. So basically 150 million was not looked after and disappeared to some extent or another, and you went down to 300 million, so you should have had a value of 450 million if everything had been done right. So that means you're at 2/3 of your original value, but that means that 12 million would turn into 18 million if it was still there, but that's still a long way short of the 57 million that PowerCo's paid in dividends in 2018.
And I think the key thing is that we've got a dividend policy that is focused on actually growing the value of our fund. Now, I can't talk to what PowerCo's owners in terms of their dividend policy, because they potentially are looking at as a cash fund, dividend only, as opposed to growth, and I'm not sure what their metric is.
Very good. Thank you. Next we have Councillor Houlihan.
Thank you. What happened to the power bills for the people after the sale?
In terms of, well, all of our power bills have gone up across the country ever since then. I think you heard Toby Stevenson talking about essentially the power bills are determined by the Commerce Commission's either the default price path or customised price path, and so that they've been on a pretty stable upward trend, and they've been determined by the Commission. And part of the customised price path process that I talked about, I think that saw those charges increase to fund that additional capital and operating requirements. So the power bills for people in those areas have essentially been determined by the Commerce Commission process.
So compared to the price that it was running, that they were getting under the council, were they kept at that same level, or did they go up from that? Because I'd imagine the council probably subsidised it a wee bit, did they?
No, the council never subsidised it. The PowerCo was always treated as an investment, so the investment was delivering dividends. But council had initially, when they owned the shareholding, they had an independent board known as New Plymouth Electricity Assets Limited, NPL is another one of our great analogies, and essentially the model that they had was to optimise revenue across the networks. They were fully commercial, based on fully commercial operating model.
So compared to the rates from what council had them at to what they are now or after the sale, given them, or give and take a wee while, how much did they change?
Yeah, and so, I mean, there's no material difference at all of if council had retained ownership, because the model, all of the models that council has had for its investment portfolios is that they operate on a fully commercial basis, so that they're not looking to offset people's household bills by taking a lower return.
Right, so the prices have stayed the same. That's what you're saying.
Well, the prices have gone up, but they've gone up because they were always going to go up based on the Commerce Commission's model.
Could you talk a bit more about, I was going to ask you, but the question's been asked, but just to get a bit more clarification around that, so the money you get from dividends from the interest from the fund, you put back into reducing rates. Is that what you were saying?
Yes, yeah. So we have a dividend release. So it's around 11.5 million. So it's paid in quarterly instalments, and we issue quarterly invoices. So when you get an invoice from New Plymouth District Council, it says here's your property details, here are your rates, here's the different elements, and there's a line in there that says New Plymouth Perpetual Investment Fund rebate, and so it comes through as essentially a discount to your rates.
Councillor Vandervis.
Did I understand correctly that when you first sold Powerco 20 years ago, it was sold to someone called Babcock and Brown?
Babcock and Brown Infrastructure.
And was then on-sold rapidly or not?
It was partially, they during the GFC, which was 2008, they sold 58% to QIC, and then later on in the GFC, the remaining 42% was sold to, just trying to remember, I think it was Brookfield Group, and then Brookfield divested, and then AMP Capital. So there's been multiple share sales, and I believe there's one, there's part of the Powerco is for sale, part of their shareholding is for sale right now.
So there has been ongoing interest in the value of the Powerco business?
Yes.
When it comes to the Perpetual Investment Fund guardians, as opposed to your councillors that you needed 75% of to get any changes, how were those Perpetual Investment Fund guardians chosen?
Sure. I thought you might ask that, so something I prepared earlier. So we have a policy within, and it's actually within the trust deed, which says, one, they can't be a past or present member of council. And basically I have a chair of our CCO's committee, Councillor Mari Pearce, and the Deputy Mayor and myself, along with our CEO, interview. We go out, we've got a company called Board Dynamics, which is a specialist board recruitment advisory. So we go out to them with a proposal to bring back directors as they cycle through. And then we interview them, and the board members are Michelle Suey, she's a financial investment professional with 25 years of experience. Richard Ansell is the chair. He similarly is a financial investment specialist. We've got Mark Wienick, who's ex-ANZ Bank, and so he was corporate services manager for ANZ Bank, and then Sarah Vreed, and she's ex-Treasury. So what we've got is a mix of kind of regulatory, financial and investment banking expertise overseeing Mercer, the fully outsourced agent.
Very impressive. So you've really got a bunch of professionals as well as your councillors that need to agree on any particular divestment of the resource. Is the trust deed that you spoke about part of the new Plymouth District Council Act of Parliament ring fencing arrangement?
The deed itself isn't. The Act of Parliament, which is included in as an appendices to the document, makes reference to it. Because there is the ability to change the deed in the instance of an extreme event. So we were mindful that we didn't want to tie ourselves up in knots and have to go back to Wellington should the volcano erupt. As you've pointed out, for the deed to be changed requires the Guardian's approval and 75% of council.
Great. Now, in terms of ring fencing or safeguarding any investment that we decide that we're going to do here, are you happy that the arrangement that you have laid out is something that would apply equally well here? And have you learned anything from it that could make it an even better safeguard?
It's as good as I could get it. And what I'd say is that, as I said, I think if you look at what Mayors Brown has done to save himself a few bucks on a consultant, he's just cut and pasted and stuck Auckland Future Fund on the front. I actually think it's a really good model in terms of, look, my values are about paying some things forward, but we've got to look after people now. I think it's as good as we can get it. As I said, we looked at this idea of a community trust, etc., but the halo benefits in terms of your credit rating and your self-insurance, I think it reflects, we're all learning about insurance risk. And I think, one of the things that you need to consider, I heard someone ask a question, if there was a major event here, and let's just call it a huge severe weather event that does damage to your city assets as well as your networks, will the government look differently on a Dunedin city-owned Aurora versus a Aurora owned by some other organisation? The government will look at it exactly the same and say it's got nothing to do with us. They are not going to fly in and help you. They may help you with your city assets, and you've seen that in Christchurch, but if you look at what they've done subsequently with Cyclone Gabrielle, etc., as they're realise that they're overcommitted, they're pulling back and they're shifting costs to council.
And lastly, you talked about an unaffordable or unsustainable $3 million in insurance costs, and you've mentioned self-insurance. Do you see the trend to self-insurance really as being the way that councils should go, given 20-30% increase in insurance premiums?
What I'd say about that is we've realised that we've got some work to do there to understand the risks and the rewards. The issue I have is I've stayed with some relatives recently in Brisbane, and we had an actuary join us for dinner. I wouldn't say that I'm confident betting against the actuaries, but I think that you need to understand what risks exactly that you are facing, and then what the cost you are charging. Where we've looked to take on, so for instance in fleet, we actually thought, right, we've got these high vehicle premiums for our staff fleet. We'll look at what we're paying and see, can we self-insure for that? Because it's kind of actually quite a small amount of risk. But actually when we looked at what we were paying, it was actually pretty much right on what we were claiming, so there was no benefit. What we understand though is that we're going to do more work in risk to better understand it and to make determinations, because with the insurance climbing at 20+% a year, it isn't affordable. And what it will mean is likely that we're building up these reserves, and we'll probably pull coverage back or look at how we can modify our premiums, excesses, to see where we get a benefit. But I'm not saying we're going to climb into self-insurance, because we're also reasonably conservative in our approach to risk. But what we've understood is that this profile is working against us, and so we're looking to educate ourselves as a council to better understand what risks we've got covered, what we don't, and where there might be opportunities to try to at least put some downward pressure on an upward cost curve.
Right. Councillor Gilbert.
Thank you. A few questions, I think. The first one is, you mentioned the GFC. You also mentioned that it took a little bit of a dip during COVID, etc. So how did your PIF cope with the GFC?
Tasmania.
Yeah, so if you go back to that,
Don't forget your microphone.
Yeah, look, we took a dip, and I think you'll see it in our statement of investment policies and objectives, where we've, that sort of period of between sort of 5 and 3 years, we took a dip, and I think it was probably around 10%. And I think when the SIPO covers off essentially our beliefs, investment beliefs, and our appetite for risk. And what it said is every 5 years, it might be every 10 years, that we accept that our investment fund may drop by 10%. There's also a note in there that says every 100 years, a 100-year financial event, it might drop by 20%. So it kind of that determines our level of risk, whereas if we were in if we had a higher risk appetite, those numbers would be much higher. So look, we dropped off, as I say, when I started in 2016, the fund was at about 300 million, and then here we are, sort of, it's been 7.5 years. Time flies, and we're actually in the comment they made last week is that by the time we get to the end of the month, it'll be around 380. Plus, it's paid those dividends in the interim. So really, it's tracking at about sort of 7.3% since we put this model in place, which was around our expectations was around sort of between 7 and 7.5.
And so next questions are about the Guardians of the PIF, which sounds like a pitch for a Marvel movie that didn't make the grade, to be fair. But do they have to be involved in terms of, so your geofencing? If there were to be the majority mindset within the council to change the geofencing, would that need to go through the Guardians or not?
No, that would need to go back down to Wellington because they need a bill to unpick it. No, we obviously keep them abreast of the things that we're doing, but their role is literally to safeguard the investment, to update the statement of the SIPO every 3 years, and then to determine who's the best outsource agent. So they have the ability, if they're not happy with Mercer, to appoint a new investment outsourced agent. But their role is basically spelled out within the governance deed. So their job is to essentially write the SIPO, appoint the director, the investment agent, and then deliver, and then report back quarterly. And also they do quite a good role in terms of educating the council in terms of they come in and they generally the way that the meetings are held quarterly, they'll give us a summary of the performance, and it's kind of a slide deck that this is part of, and then they'll bring in different people to talk about, for instance, ethical investing or a particular area like alternatives or something where people want to understand, okay, we're 10% of this, what does actually that asset class look like, and what's the trend in that?
My final question is, again, still on the Guardians. So I believe I'm correct in saying that for any diving into of the fund, the Guardians need to be on board plus 75% or more of the council. Right, cool. So is it fair to say, though, that the chance of there being the chance of all the Guardians and 75% of the council agreeing that you need a new stadium or something and diving in, something, hefty, is greater than zero?
I think you've hit it on the head. So you go, what's the counterfactual? The counterfactual is that you get a charismatic mayor that decides they want a stadium, or whatever it is, a monorail I always like to think of. They will have to sack the board, because the fundamental, and when you see the PIF trust deed, the fundamental investment belief right at the top is that it is a perpetual investment fund. So these people have been hired to safeguard New Plymouth people's public wealth, and so to raid that for any other reason apart from the volcano has wiped out, say, a water treatment plant and a whole bunch of other assets, I suspect they would have to be fired, and then 75% of the council determine to then move in.
I lied. I have another question because you've just given me one. So the firing of the Guardians, what is required in that? In the setup system that you've got, what would be required to say thanks very much, don't.
That would be a decision of council to terminate.
Full, just a standard majority or super majority?
The super majority is to change the governance deed. It's to fire the CCO would only require just a simple majority.
Councillor Barker.
Thank you, Kia ora, Neil. Just going back to 2004, because we were almost in that position when looking at selling, and I see that there was a 53% stake. So it was, is it true that it was partly owned by New Plymouth District Council and they owned 38%? And then Taranaki Electricity Trust must have owned another bit, and Powerco Community Trust another bit. But it's just the council's bit that was the 38%, is that correct?
Yes, and what the council did was they got those other people with what they considered significant sums they collectively pooled and determined to go to market.
So at the time it said that there was, it was a bit of a deal, and there was some 8.5% securities, and then there was, what was the other? Oh, so there was some cash, there was some high yield securities. So over time, has that just morphed into being a more general fund? So there was periods that it went through, and obviously the investment in the Tasmanian Dairy Fund, was that taken out of those high yields and others and put into that?
So yeah, so you're right. So the Sparks was subordinated prime adjustable reset junk bonds, because the business was trading at $2.05. But they got a $2.15 offer, but it included, and essentially it was vendor financing for Babcock and Brown. So, and that was placed with Taranaki Investment Management Limited, which was the precursor to the model that we have now, which was basically they just had an office in the council building, and they got the cash and those bonds, and then they subsequently started their investments. And as I've indicated, they didn't end up with a diversified portfolio of assets. But they did maintain a significantly increased dividend stream, which created some real difficulties for the organisation.
So when I look back at this, said that there was some advice from PricewaterhouseCoopers, and it said the annual return of 19.3 million was achievable. And I'm just wondering, you've said there's around, it was $11 million. Oh, sorry, $11.5 million worth of cash back to council. So is there $8 million that you're getting back into the fund every year? I'm just trying to see the difference between what was promised at the time in 2004 and the realities now.
And I think I need to make it really clear. What was promised at the time was that this business, the investments, could beat the market. I don't believe that was accurate. That doesn't line up with the investment beliefs that we have within the model. But that was a statement that was made. There was also a statement made that people in New Plymouth would be rates free, that the fund's return would offset all rates by 2020. I don't want to get into all I'll just say is that those are not the beliefs that we hold. We fundamentally believe that if you diversify your investments across the market and index yourself accordingly, you can achieve the market returns, and that's our objective, which is that the fund in real terms delivers 3.3% or more return, and then we take a dividend of 3.3%.
I guess what I was getting at is in the news article that I'm reading, it says in order to achieve an annual return of 19 million, our most recent dividend from Powerco, so that's comparing the dividends that they were getting at the time when it was sold to the dividends, etc., from the diversified fund. So would you, looking at the history of it, which seems to be a little bit complicated, do you think that was overstated at the time, that they would get the $19.3 million, or was it just because of the history of less than ideal investments that has kind of knocked this model around?
So, as I said, the key thing is that they had a belief that they could beat the market, and then they didn't diversify, and then they paid out, and essentially they paid the capital base out as dividends through 2008, 9, 2010, and it was suddenly in 2011 when they had a change of leadership in council, and that was when the release was significantly reduced, and council had to go on a cost cutting exercise.
Just one more question then. So what was the actual cash there? I see that it was sold for $360 million, 53% for all of those three shareholdings. What was the actual 38% stake?
It was 259.
Great. Look, I'll take a question from Councillor Weatherall, then have a question for you, Neil.
Thank you, Neil. Thanks for coming down today. Around your diversified fund, does your council impose any restrictions on allowed investments, so to speak? Or do you leave it up to the fund managers 100%?
We've asked them to meet what we call international best practice ethical investing. So what that means is we're not invested in cluster munitions, but we are invested in Coca-Cola. And we've worked with Mercer, and they actually come through and talk to us about our investments and what that means. So within the statement of investment performance and objectives, you'll actually see how we've articulated that. So they're focused on it's a fully commercial basis, but we have asked them to ensure that we're an ethical investor. And then the definition of that is actually covered by Mercer and covered in the reports. And we're also, and the councillors have been able to ask for quite granular levels of, literally the list of every investor. And I've got a wonderful colleague, Annika is our resident vegan, and she's not a big fan of the likes of Coca-Cola and some of the other food industry areas where we are invested. But we've explained that, as I say, we're not into cluster munitions, and various things like that. We're also not into tobacco, but I think we've got stocks in the oil and gas sector as well.
Right. Now, thank you. We're past 3 o'clock, and everyone, as many different councillors as possible, have asked questions. We could go on for a bit longer, but I think you might need to be...
Neil needs to leave, but before he does, can we just... We could make a point of clarification about one of the statements which was made earlier, comparing the PowerCo dividend in 2018 to the distribution from the diversified portfolio. Chris, are you...
I think my question for Neil is despite the investment decisions you made, the starting point was only a 38% stake, so that's going to also influence the relativity. Is that correct?
Yeah, and also remember there was a $100 million investment early on, which would have, council's share of that would have been $38 million.
And can I just make a point? When I looked at it...
If just 1/3, then that would still be 22 million versus 12.
Yeah,
so the 51 million, just to be clear, was for 100% if you owned 100% of PowerCo. And New Plymouth District Council sold 38% of PowerCo.
So 56 million times 34% brings you to well over 12 million.
I'm just clarifying the numbers, and I don't think that's the full picture as well. We'll come back on that in due course. Thank you.
I was just I was looking at the figures, and you had the dividend of 11 odd million, but that's only, which works out to be 3% of the value of the fund. So the fund made 7.2. So my question is, was the other 4% of the fund, which would have been, 14 odd million, was that retained in the fund for the growth?
Yes, and that's the idea. The nature is the nature of it is that we take on average 3.3% of the value of the fund each year as a dividend for the council, and that any additional is actually retained within the fund to continue to grow, and that's the perpetual nature of the fund.
So the emphasis is on growth, because when the fund made 7.2, you actually invested something like 4% into growth.
And look, I don't want to get into too much detail, but it's covered in the report. We also have a dividend smoothing policy. So, and there's a formula spelled out, but in a nutshell, what it does is 80% of the dividend is based on what was paid last year, so you don't get a massive shock, and then 20% is based on that 3.3% value. So what that means is, in a COVID year, when the whole thing drops by 10%, that 80% but was based on the previous year, so we still got around 8 or 9 million, and then the 20% is based on the value of the fund, so that dropped. But what that means is councils like nice smooth cash flows, and so we've got a formula. It's actually the Stanford University Trust model, because we figure why not pinch someone else's ideas, and what that does is gives us that certainty. And then anything that we don't need is left in the fund. And the same with these reserves that we're going to use for self-insurance. We're actually just not going to draw them, and we'll leave them in the fund so that they will grow.
Right. Now I'm just concerned you need to get going. Yes. And look, thank you very much for coming down and presenting to us. We very much appreciate your practical experience in the matter, and I hope you're in time to catch your plane.
Sure. And look, if any of you have ever got any questions, the Mayor's got my phone number. I'm more than happy to take a call. Thank you.
Thank you. Sorry? Sure. We've only been here an hour. But yes, look, before we get I'll come and say cheerio. Yeah, we'll take 5 minutes. Take 5 minutes, and before we have the next one.
That was mentioned several times in the consultation is, or was, the risk return profile of a diversified fund, and were the assumptions that were used in the analysis provided through that consultation sensible assumptions to make. So we thought to that we'd ask Matt to come along from Forsyth Bar and talk about the characteristics of a diversified portfolio when considered on a long-term basis. So, Matt Henry, over to you.
Sure. Thank you. Sorry, thank you. We will bring that up, will we? Thank you. Look, thanks for having me. Look, as a very quick introduction, I head up the research team at Forsyth Bar. I've travelled a long way from next door today, so I think probably most people in Dunedin are familiar with Forsyth Bar. It is the spiritual home of the firm, and obviously we sponsor New Zealand's best stadium in the city. But as a firm, we're about 600 people across New Zealand, 25 branches, and manage around about $30 billion of client funds. And that's everything from mum and dad investors up to large institutional clients, the likes of iwi groups or community trusts or other local government entities. I was asked to just provide a high-level snapshot around the characteristics or features of what a fund may look like along the lines of what potentially the council may establish if it did advance this process. Just putting, I guess, sort of thoughts around how we've looked at this in context. Ultimately, when anybody, person or any entity sits down and thinks about building an investment portfolio, there's a range of assets they can choose from. And at one end, you've got low-risk assets like cash in the bank, which doesn't move around very much day to day, but over the longer term doesn't deliver much in the way of returns. And at the other end of the spectrum, you've got higher risk assets such as stocks on the share market or investments in private companies, which can move around quite a bit day to day, month to month, but over the longer term offer significantly higher returns. And the reason for putting this first chart up is really just to highlight this. So the flat line, the blue line that ultimately ends up at the bottom is if you held 100% cash. And so you can see a fairly smooth return over time, but ultimately a lower return than if you held stocks. And each line essentially is holding 10% less cash and 10% more stocks. And these aren't the only asset classes you'd hold, but just for illustrative purposes, what we're trying to highlight is that ultimately you're trading off short-term movements or medium-term movements for higher long-term returns. And for any long-term organisation, like a council, like an iwi group, like a community trust, one of the benefits they have is that perpetual long-term time horizon. They shouldn't worry too much about what the value on the market of the assets are next week or next month. Ultimately, what they're pursuing is long-term intergenerational goals, and therefore have got the ability to look through that volatility and hold a higher growth portfolio. So for illustrative purposes, what we've assumed is a portfolio which is 80% in equity assets across New Zealand, Australia and globally, and 20% in lower risk assets like bonds and cash. This isn't definitively the right solution for the council. Ultimately, there is no right solution. It's a subjective balancing act depending on the needs of any organisation. But for the purposes of this exercise, that's the assumptions that we have made. And I was asked just to highlight what the returns might look like from that sort of portfolio over the long term. And so going back essentially to 1970, because that's the period we can get decent data for, that portfolio has delivered annual average compounding returns of around about 9.6%. That excludes any benefit from active management, and there's different views around whether there's value in active management or not, as the Mayor before me alluded to, and it doesn't include any investment in private market investments. And this is not like the farms that we were talking about previously, but this is investing with specialised fund managers who invest in private assets. So that would really just be if you'd bought the market and held it unchanged over time and hadn't made any changes depending on your views of the world or views of markets at any point in time. I guess two funds you will be well familiar with that have that long-term horizon and that provide public data around their performance are the New Zealand Super Fund. So the New Zealand Super Fund was established in 2003. Their benchmark has delivered 8.3% over that period. They have delivered through active management 9.8% per annum. So we're talking about similar type numbers to that long-term average. For what it's worth, that the super funds asset allocation is similar to that example that we used previously, with about 80% in growth assets and about 20% in things like bonds and cash. The ACC, New Zealand's Accident Compensation Corporation, has also delivered something in that ballpark, 9.3% per annum over 32 years since its establishment in 1992, and above their benchmark of 8.1%. So just trying to highlight here the sort of range of returns that these long-term funds have delivered, and I guess also just commenting on some of the benefits that you can get from active management of those funds. Just to put in perspective, the difference between say 9 and 8% doesn't necessarily sound like a huge difference, and it's not in any one year. But if you invested $100 million today, that 1% difference over 10 years is about $10 million. After 20 years, is about $94 million, and after 30 years, about $320 million, assuming you reinvested all those funds. So, those small return differentials do add up to meaningful differences over time, and most importantly, the ability of the organisation or the fund to undertake whatever its purposes for the benefit of its stakeholders is enhanced by those modestly higher returns on an annual basis. One comment I made before was just about volatility. The reality is that markets that are traded on exchanges, the valuations are priced every day. One of the reasons New Zealanders feel more comfortable in houses is they're not priced every day in the newspaper or online. But it doesn't mean they're not moving every day. But the importance of time frames comes into play is crucial when you're thinking about how important those day-to-day movements are. So just illustrating here, the portfolio we've assumed, in a one-year period, there's a 20% chance, or in 20% of years, that portfolio delivers a negative return. So 1 in 5. That falls in a 2-year, 3-year time frame to around a mid-teens, so slightly lower. Drops again over a 4-year time frame to less than 10%, over a 5-year time frame to less than 5%, and then 0% of times over a 6-year time frame where returns are negative. So this is just one way of looking at volatility. The point being is that you get volatility over the short term, but the longer your time frames, that volatility averages out. And the longer time frame you have as an investor, you have the benefit of looking through that short-term volatility and focusing more on the the returns that you expect over that long-term horizon. We thought it was also useful to look at Vector as being the only current listed company that operates energy networks. Powerco was listed, as previously discussed, for a period. So Vector's been listed since August 2005. It hasn't been a bad investment. They have delivered an annual return of just over 7%, and that compares to that growth portfolio of just under 8%. So has been below, but by around about 700 basis points. To put that in context, again, that $100 million figure, if you'd invested $100 million in Vector versus the growth portfolio, today you'd have about $50 million more in the growth portfolio than Vector. So the returns have been above. I think it's important when you're thinking about Vector as a benchmark is just to understand the history. One of the things that Vector has benefited from over its period of time is the significant sale of assets. So in 2008, around the global financial crisis, it sold the Wellington electricity network. So previously it owned both Auckland and Wellington and sold Wellington. Then in 2015, it sold the New Zealand gas transmission network and its non-Auckland gas distribution networks for nearly $1 billion. And then last year it sold 50% of its metering business across New Zealand and Australia for $1.7 billion. So just those three transactions alone add up to around about $3.5 billion, if my quick maths is right. To put that in context, the total market value today of Vector is about $3.7 billion. So these are very significant transactions for Vector as an organisation. And it's really those transactions that have enabled Vector to continue to undertake its capital investment requirements and maintain its dividend. The other observation we'd make about Vector is that it's actually been significantly more volatile as an investment than the growth portfolio. And so I think it'd be easy to sit back and say, well, Vector's a relatively low risk business. It operates in a sector where demand is defensive, and defensive meaning not significantly impacted by broader economic conditions. And therefore, it's likely to be a more resilient company, its stock price is likely to be more resilient. But this chart highlights that hasn't been the case. So what the two lines are, the brown line is Vector's share price relative to its previous high, and the black line is the growth portfolio's value relative to its previous high. And you can see that that brown line has been a lot more volatile than the black line. So there's been a lot more ups and downs in Vector than there has in the the broader market. But two, the drawdowns in Vector, the pullbacks in Vector have actually been a lot more significant than that growth portfolio, and that's due to a combination of things. One, you've had some regulatory surprises out of the Commerce Commission over time, which is really that first pullback early on and probably that one in about 2014. During the global financial crisis, Vector's share price pulled back more than the market, which may surprise you given that defensive nature of its earnings. But the concern really was around Vector's balance sheet. It held a lot of debt at that point, and its debt wasn't well structured. And so there was, when credit markets froze up during that period, there was concern around Vector's balance sheet. Really, the reason why they sold Wellington Network was to get themselves out of that debt hole. And then more recently, you can see that Vector's been weaker than the market because interest rates have gone higher. So when we were in 2020, 21, and interest rates got to the lowest levels in human history, people looked at assets like Victor as replacements for putting their money in the bank account. But you can see as interest rates have gone up that share price has pulled back. So, I think it's just worth acknowledging that even though intuitively you would feel like Victor should be a less volatile company than others, when you're looking at a single asset, it typically does move around more than the broader market. So really, for me, the quick summary is when we look back in history, if we use history as a guide, then we would expect higher returns and income out of a broader portfolio than a single defensive asset like an energy network. Certainly, there is real, I think, benefit around a diversified investment portfolio. Ultimately, that aligns with not putting all your eggs in one basket. Certainly, with a number of our local government clients, ensuring you're getting maximum diversification out of other assets, investment portfolio assets is of key importance. As we saw with Vector, having debt exacerbates financial risk, even if you've got a relatively lower risk underlying investment, and it would provide a liquid portfolio that you can access if there was a major event. My last point, which the Mayor previously touched on, so I won't go into detail, but I just wanted to accentuate the importance of ensuring that if the process was advanced, that I think the most important thing for any organisation is establishing the appropriate governance structures and rules and documentation up front. He talked about how they had a few missteps early on in their, investment journey. They're certainly not alone. We could point to a number of organisations who've taken a little while to get their structures right. But I think with any organisation, doing that work up front around governments is of utmost importance to ensure that any funds that are available for investment are preserved for their long-term objective, in your case for the benefit of ratepayers and the people of Dunedin, and to ensure that the funds are managed in accordance with that overall mission and those overall objectives. So I think he covered it pretty well, but I think that you can't overestimate that as an important message.
All right. Are there any questions? Councillor Gary.
Thank you, Mr. Mayor. Thank you for that. When we went out to consultation, it was really important to me that the wording be very specific around diversified investment portfolio and also professional fund manager, because there'd be many people in the community that would make a difference to, but there'd be others who are not familiar with those terms or what that means. I just wondered if you could articulate, I know the answer to it, but I think it's important that we're really clear when Neil was talking about the Tasmania dairy farmers, dairy farms, and them basically having all their eggs in that basket, which is obviously quite a disaster for them. That would never happen under a diversified investment portfolio that's actively managed, would it?
No, it wouldn't happen. The key thing, as I guess concluded on, is establishing that governance framework, an independent investment committee, most likely, with appropriately people appointed, with governance rules in place around how they operate. As the Mayor mentioned earlier, a SIPO, a Statement of Investment Principle and Objectives, which outlines I guess, the rules of engagement, so everybody, all stakeholders, whether it's the council, the public, the investment managers, all understand what the objectives are and how it will be implemented. And so during that process, you would clearly outline the limits and the scope for investment, and I would assume that would be excluded from it.
And just tangent to that, but important, Neil also talked about ethical investing. That's par for the course these days, is it not?
Yes, it is. It would be very unusual for any organisation, whether it's a public body, whether it's a charity, to not have an ethical investing policy that sits either within or alongside the SIPO. Again, that how far you want to go with that comes back to the choice of the organisation. One of the things that we do is sit down with the organisations, talk through the options. Ultimately, it's up to the council to decide what's important to it, because every organisation, everybody's values can be slightly different.
Thank you.
Fantastic. Councillor Barker.
Thank you, Mr. Mayor. Could I just wonder about what is the cost of running a portfolio? So say we had between $1 and $500 million portfolio. Is it on the management costs, the investment managers? And I see there would be an independent investment committee, and I assume we'd be paying those, and a investment manager. So when we're given an example of perhaps a 7% return, is that before or after fees, and what sort of percentage is there in running an investment portfolio?
Yeah, it's a good question, and I'm going to try to answer it without skirting around the question. A little bit, it depends ultimately on how you go through a process of establishing the SIPO, and that determines what your potential investment universe may look like, and some of those investments may have higher costs, and some of them may have lower costs. Ultimately, you would only choose the higher cost investments if you believe they were going to deliver a higher return. There's ultimately no guarantee behind that, but that's the reason you would pursue them, or they delivered some diversification benefits to the council's broader asset base and objectives. But typically, if you're talking about somewhere in the order of 100 million, let's say, for example, you'd be looking at, I'd say, costs around about somewhere between 0.3, 0.4 at the bottom end, up towards 0.8, 0.7, 0.8 at the upper end would be my sort of rough expectation of range.
Thank you. Are there any other questions? Oh, sorry. Deputy Mayor Lucas. Yes.
Thank you. 2 questions. Thank you. 2 questions. One is, do you know what the long-term return has been on the Waipori Fund to date? That might be a question for Dunedin City Holdings.
Yes.
And my other question, and it's something that a lot of people have asked me, is, and just your opinion on this, is why would we forego an almost guaranteed return from Aurora because of the regulated environment within which it operates, to put that money into a diversified fund where the return, as you've demonstrated, is going to, you can't actually say this year it's definitely going to be this. We've got that volatility of the market to contend with. So what would be your reply to someone who asked that question?
I'm not close enough to Aurora to provide a firm answer on that. Look, I think, first and foremost, my concern would be around just diversification of assets. We have I had a discussion with a regional council, and they have an investment fund, and one of the critical things we were navigating through was how do we best use this investment fund to provide diversification to the current assets they have, because as a council, your rate space is local, and often you've got a significant asset base which is also local, whether it's property or infrastructure assets being the main two. And I think we all appreciate that as a country, we're not without risk. We're a small economy. At the bottom of the Pacific, we sit on two tectonic plates. We have cyclones come down from the Pacific, and we are relying on agriculture, which has biodiversity by risks. So, I guess first and foremost for me would be the question around not that Aurora is a bad asset or a good asset, but when I'm thinking about that overall context of managing risk and return across my broad asset base, and I think about that broad asset base, including my rates and including the potential costs I will face and may face in the future, does it best fit that portfolio? For me, that would be the number one question I would be asking. Beyond that, I guess you get into some specifics around Aurora, which I'm probably not best well to place to talk about, which is what potential income streams will I get out of it? What capital requirements are there? What debt levels can it support? All those sort of specific things, which I guess you consider with any individual investment. I guess what we saw with Vector is that even businesses of this nature are not without risk, because you've just got all those eggs in that one basket.
Thank you. Councillor Barker.
Always have a challenge with decimal points, so I just want to go back to that. If it's a $100 million fund and it's 0.3 to 0.4 points, is that $300,000 to $400,000 to run a year, or am I missing some decimal points?
1%, being a million. So you're talking about.
And that's for a low risk portfolio, but if it were to move to a higher risk portfolio, and you said about 0.8, would that be 800,000 then? Okay, cool, thanks.
That would be. Sorry, apologies. And that would be when you're pulling in specialist managers of specific asset classes where you felt like potentially there was return and or diversification benefits for looking at those assets.
So that's a per year, you can't just get a set and forget? Just had to ask.
Typically not.
Right. I think we've covered all the questions. So, thank you very much. Thank you very much. That's great.
You're welcome. And, all the best with the process. Thank you.
Yes, we appreciate you coming along. Thank you very much. Golly. Now, Mr. Anderson.
So, last but not least, we thought it'd be good to have a session with the CEO and Chairman of Aurora, maybe to recover some of the themes being covered already today, but to get the view from the company itself. And I think, Steve, you've got some initial comments to make, and then we'll open for questions as well. Thank you.
Yes, I do have some initial comments, but I understand the session's primarily about the opportunity to ask questions of us that have arisen during the day. But just in terms of giving an Aurora perspective on things, the sale of 100% of Aurora is a shareholder issue. It's not something that is of particular concern to the company one way or another. The position of the Aurora board and management is that we need our shareholder to be able to provide the capital or debt we need to meet our cash flow shortfalls. And the business currently doesn't produce enough cash on its own, as you've seen, to meet these requirements. The future of all EDBs, including Aurora, is significant capital spending to meet the effects of decarbonisation, energy transformation and growth projects. And that's, of course, as we've heard, in addition to the normal renewals and maintenance expenditure that every EDB faces. There's a fair degree of uncertainty around exactly how much funding will be required, but one constant is every time we review our projections, the debt number doesn't get smaller, and you've heard that on a couple of occasions today as well. And I just thought it might be useful to reflect on the Boston Consulting report that was released a wee while ago relating to the energy sector. And they identified that actually there is a step change related to decarbonisation in the sector, and it applies to everyone. And their expectation is that that's going to last at least 30 years. So we've broken the back of the backlog at Aurora, and so we're now just facing that step change as well, like everyone else is. So I don't expect our future capital projections to go down. I think there's significant upside risk in those, and it's just about every year that we see that. If Aurora isn't sold, then we assume that, if Aurora is sold, we assume the buyer has access to the necessary funding, because they'll be interested in providing as much funding as they can to support the regulated return, because that's why they would have bought the business in the first place. And I think you can see that with the PowerCo purchase, where they injected capital in early on to support their purchase and support the CapEx program at PowerCo. However, if Aurora isn't sold, then we're assuming that the DCC and DCHL together are committing to providing the funding that the company needs. And that's because of the projected cash flow deficits, which we've talked about to 2034, but actually, and you'll see that they look like they tail off, but that's not my belief. I think we're looking beyond a decade, well beyond a decade, before we can produce enough money on a free cash flow basis to fund our capital program, not the least paying dividends. So the consequence is that over the next foreseeable future, any dividend payments that the shareholder is going to expect to receive will need to be debt funded for sure. So our main concern is that the future funding requirements can be met by the shareholder, whoever that might be. And I'm sure you appreciate that. However, there is a bit of a sting in the tail. If a partial sale is contemplated, then the company is interested in that, because it's the company that's selling part of its assets, assuming it's not a sell down of shares. So there was some talk about Central Otago being sold. So that is a concern, that would be a concern to the board and management. And I don't think there would be support around the board table or management for a partial sale. We've previously looked at all sorts of options as part of our strategic planning. And I mean, it just simply doesn't make sense to sell an asset at what I would say is undervalue. We'd be exchanging an interest cost of 4.5% and giving up a return that we can get on the regulated regime of 7.4%. So that on its own just doesn't make sense. So it would be a very poor decision. We've got a duty of care to the company and a duty of care to our shareholder under the way our constitution is written, which is a wee bit different from most. And so I don't think the board would be happy to approve a partial sale on that basis under that duty of care obligation. There are a heap of other reasons why a partial sale doesn't really fly. Partial sale of some of our assets doesn't fly. And, you know, critical mass, as you've heard, is absolutely fundamental to us, and we've got it at the moment. We're part of the Big Six nationally. That's a hugely important place for us to be in terms of being part of the future networks program and what we need to be doing to be ready for decarbonisation and the costs associated with that. And we actually play a big role in it. We're already market leading in terms of what we've done in the Upper Clutha with Solar City. That's held up as an exemplar for the industry. And so those sorts of things just simply wouldn't happen if we ended up with the urban network in Dunedin. And then, of course, poor old Dunedin consumers could likely expect an increase in their costs as a result of that, because we'd be spreading a fixed cost base, which would be a little bit smaller but not a lot, over a smaller number of consumers. So there'd be an expectation of increased costs for Dunedin consumers. Now, that's not about, it's not subsidisation exists now, because it doesn't. It's just simple maths that if you reduce the fixed cost by less than the ICP input, then you're going to end up with a higher cost per consumer in Dunedin. Then there's reasons related to staffing and resourcing and that sort of thing. And our team of people who have carried out the CAPEX program and the senior exec team that we've actually cobbled together over the years have done an amazing job to get us from where we were to where we are now. And they came here because of the challenge. And we've got some New Zealand leading people in our organisation, and they will not be hanging around if they're just dealing with the Dunedin network. So that's another issue. The separation process itself, that's problematic in the extreme. And Councillor O'Malley talked about the fact that it wouldn't be a big problem because they weren't physically integrated, but actually they're operationally integrated. And we've spent a number of years operationally integrating the two networks. So now we'd have to find a way of decoupling them, and that isn't exactly straightforward, and that could take quite a period of time. And look, I've got a long list of other reasons, but you get the drift. We're not interested in a partial sale of the assets to deal with the debt problem, and we don't think it's economically viable and the right decision anyway. So, end of story. Our main concern is access to funding going forward. We expect that funding to be in strong demand in the future, and that's supported by Boston Consulting Group that say that the future looks like intensive capital programs for distribution companies. Happy to take questions.
First question is Councillor Benson-Pope.
Thank you. Thanks, Steve. I raised the question earlier about insurance, and that was a surprise. Well, that was an enlightening moment for me. I assume that's in relation to the network itself, but all your other physical assets like buildings and the rest of it are appropriately covered.
Absolutely, they are. Yes.
Question of what things?
Microphone.
Question I'm interested in is in the situation where cross-subsidisation is prohibited, limited-prohibited by the regime, how do you cope with the pressure area, which is the growth in part Queenstown and or Central? They are paying higher line charges because of that pressure.
Not so. No. The reason the Central Otago line charges are higher than, say, Dunedin is, you've got an urban network with dense ICPs, the people who connect to the network. So you've got this density, you've got a very tight network of poles and wires and a high number of people using them in a very close proximity. Central Otago is one of the most sparse networks in the country. And so the regulated asset base in Central Otago is a significant number for the number of consumers in that region. So it's purely a product of the maths from that.
Okay. And that disparity in population outweighs the pressure demand of the growth for new infrastructure in Central.
Well, actually, the growth in Central helps with the problem. So over time, if you could multiply up what's happening in Central Otago in terms of growth, you'd bring the disparity more towards the Dunedin type of charging.
Okay, what I'm not grasping is how at the beginning of that process, when you're allocating the costs and the demand is on Central because of that new lines being installed and so on, how that works.
Yeah, so if there was a discrete investment, $10 million investment in Central Otago, then that was a new asset that would be added to the Central Otago regulatory asset base, and the rate of return will be allocated through to the revenue, which would flow through to prices for Central.
Good. Councillor O'Malley.
Thanks, Steve. Do want to clarify, I did acknowledge that you were operationally integrated, and that probably would where it would come from. Ultimately, then, what you're saying, and this gets back to maybe to our LGFA covenant and our debt ceiling capacity and our ratings, is that if we as the owner were able to feel confident that we could get the money for you, then you would feel more confident to be with us.
That's a shareholder issue, isn't it? Because as long as we can get access to the funding we require, problem solved.
And we are looking at over 7% return under the regulator if we could get it, right? So again, in terms of, as you just pointed out, and I think this is often an issue with debt, why get rid of something that's bringing you in 7% to pay off something that's costing you 4%? So if we can get it at a lower interest rate, presumably then we're getting it at a lower rate than it can return, but there will be a gap in return because of the pricing complexity.
Yeah, it is complex, and there's no way of answering sort of one-dimensionally. But if we reflect on the period, the previous default price path period, which was 2020 to 2025, so it was just about at the end of it, the regulated return for that period is 4.57.
We were around about 1.2 or 2 for getting our interest at that point too, obviously, though, right?
This is where the regulation isn't your friend, because, or it can be, and it can't, and it can work against you, because the pricing is set for 5-year periods at a time based on the economics that are known at the start of the period. So you can win or you can lose. There's a bit of a Russian roulette with that.
It really is that 5-year setting period that makes it different from any other business. Thank you.
Councillor Barker.
Just to clarify, 5-year setting period, I thought you talked about that the next one was going to be 3 years. Was that correct?
No. But again, it's complicated because of Aurora. So the default price path for New Zealand is 2010, 2015, 2015, 20, 20 to 25, 25, 30. But we started our CPP in year 1 of the previous default price path period. So our CPP goes through to year 1 of the next one. And then if we decide not to go for another CP and roll on to the default price path beyond for the which is called DPP4 from 25 to 30, we'll roll on to it at the end of 26 because we'll come out the end. So nothing simple, is it?
So, what are the chances of us going from a CPP to a DPPD? Yeah.
We haven't made a final decision on it yet, but I think the odds are that we will go with the default price path once we're out of the other end of the CPP.
My next question is just a general one, which was from the questions that you've heard today. Is there anything else that you'd like to clarify? Because you've heard a lot of questions and you've dumped on and clarified some pieces, but there may have been some interpretation challenges. So I wonder if there's anything that you want to clarify from the questioning that you've heard throughout the day.
No, I think we're very happy. We had the opportunity to put our hand up occasionally on the way through, so that worked okay.
Can I just go back to the number of connections? And the gentleman came through and they talked about that it was on average they were predicting their model on 1,400 connections a year, and I've gone through 10 plus years of annual reports and looked at the connections, which were very high 10 years ago, and in the last few years have been 1,100 down to 1,000. So I just wonder about that 1,400 figure, whether it was a good figure or...
I think that's, well, I think it's the latest forecast. If it's in the asset management plan, that's the latest forecast for the business. But I think it's, when we're talking about new connections, that's household connections. The thing that actually determines the uncertainty for our investment are major new connections. And so, you know, I think we talked about last time I was here, at any one time we had Terrace Airport, which was forecast last time, and that was something which we had to put into the plan. We have a Bendigo Santana mine, which may or may not happen within the period. We've got asphalt plants. There's things coming in all the time, and it's those big capacity, you know, the demand connections, which are the ones which we need to worry about, not whether it's 1,200 or 1,400, but I can check that forecast.
So it's not necessarily quantity, but quality, perhaps?
Yes.
My next question is just around, it was asked earlier today about the lumpiness of asset replacement, given, and I think I asked this about that, say some of our infrastructure, this happens in Three Waters as well, is 50 to 70 years old, and we're going to have some times of great pain where we replace a lot of infrastructure at one time. So is this happening in Aurora, or given the decarbonisation, is it actually just going to be very difficult for a long number of years?
I think if you look at we published our asset management plan every year, and that goes out, the latest one goes out to 2034. And if we're spending roughly, let's say if we're spending 100 million a year, it's about 120 million, then 50% of that will be maintenance renewals. And if you look at the last 5, 6, 7, 8 years since I started with the business, the focus was on safety-driven poles and above-ground assets and etc. We're still maintaining at 50 million a year, but the profile has changed because we're into a different asset. We're into focusing on different assets. We're really focusing on conductor and zone substation upgrades, and so it is like that. But we've got overlapping fleets which will make it steady. So I think if you look at the projection, in summary, it's about this. It's pretty constant right through to 34.
And I just wondered, I think I spoke with you kind of maybe at lunchtime about the cross-subsidy and the number of groups, because I sort of go Queenstown, Central Otago, Dunedin, and there was one of the things that was stated to us about the ability to cross-subsidise. And I just wanted to understand that a little bit more, because I think that Dunedin people are worried about subsidising, I'm just being purely selfish from the Dunedin point of view, subsidising some of the other groups. So I think you explained to me there was actually quite a lot of groups and quite a lot of challenges.
No, well, just to clarify, there are a lot of tariff groups, so the different tariffs for different customer types depending on the characteristics of their demand. What we were talking about, though, was the three discrete networks. The one feeding Queenstown, the Central Wanaka, and the Dunedin, and we price. And I think Toby mentioned earlier that we price separately for those pricing areas, and we do that, and we effectively do that building blocks model which Toby described about how you build up the revenue. We effectively do that for each region, and so the costs kind of lie where they fall, if you like, in terms of that building blocks. And we talked about that a minute ago with the regulatory asset base in Central. What we do though is we do. It's not cross-subsidy, it's cross-allocation of shared costs across the network. So our corporate services costs will be shared across the network. So there are benefits. I guess there's a benefit in being a larger company because you get that scale economy.
Could I just add to that, that the business received acknowledgement from the Electricity Authority that our pricing methodology was the first and second in successive years in New Zealand. So we get much more scrutiny than any other company because of our history, but with it has come some accolades as we've actually become best of breed as a result of where we've come from. So you can be absolutely certain there's no cross-subsidisation at all between the discrete network areas.
Just in terms of the pricing methodology and so on, what is our CCP? Because I see, on that graph that we looked at earlier in the day, we've got the 7.2 and maybe 8.8% that we achieved in 22 and 23 return on assets versus the regulatory. Is there a figure that we're allowed to go to? Because that's well above the the default price pathway of 4.6.
Yes, so so I sort of tried to explain it at the time. So what actually happened during that period when we was it 16, 17, 18, 19,
yes,
when it sort of drops away and there's a big gap between the 4.5. We weren't making any money because we were spending everything we could to make the network safe. That was dealing with the big problem that we had. That's what our role was. So we weren't. We underperformed the regulatory return and you would expect us to, because we had to spend money, but we weren't receiving the revenue for it because the prices had already been set in 2015. So we had no choice. We still had to spend the money, but we weren't.
But you couldn't put the prices up.
Yeah, we weren't getting paid for it. The CPP then allowed us to get the money for the size of network that we developed during that period. So there's a bit of a lag in terms of getting the money. Now we're outperforming it. But that's really just a blip in time in terms of the economic regulation. Over time, you would expect that we'll be hovering around the WACC rate that we're allowed to over an extended period of time. So we're just taking a very small snapshot there. We've got the opportunity to outperform, the regulatory inputs, and that's what we focus on as a board, or what we will focus on going forward. We haven't, I suppose, so much, but going forward, we'll definitely be focused on how can we outperform the regulatory requirements, if you like. But the one thing that's going to get us is the debt, the leverage. We're always going to have leverage beyond the allowances that the industry allows us.
Perhaps if I could just add to that, you referred to the period 2016 to 21, was it that? We were from 15 to 20. We were operating under the previous WACC, which was the one before the 7 point. I think it was about 7.2.
Yes, 7.2. But why did we not increase our prices to match that level?
No, this comes back to Steve's point.
Yeah, we did, but of course the spending was really significant to avoid the safety issues. So then that's what got us, and a lot of it was OPEX. So straight to the profit and loss line.
Very good. A question from Councillor Wiley.
Thank you. Through the hearings process, we heard about Lakeland, and they would the word Lakeland networks and the cherry picking of new developments. And that's owned by, I understand, by Invercargill City Council and Southland Power Company. Can you give us a better idea of what are they doing and how Aurora's model and their model have sort of coexisted or been a confrontational, or what the competitive?
Yeah, I can make a comment, or I can't explain it. So we've got economic regulation because we're a natural monopoly, but they also encourage competition between distribution companies, which sort of then means you're not a natural monopoly. But so we could go into Southland, and we actually did have an embedded network in Te Anau, which we've just sold to. It was insignificant, but yes. So what actually happens is that PowerNet tout for business in the Queenstown region for discrete networks, and they're allowed to. And so that creates quite a bit of competition between ourselves and PowerNet and whomever else wants to take part in that arrangement.
Then, when we look at Aurora in the next 10, 20, 30 years, and taking a more approach to 2060, and you touched on the transition away from, and again, you used the words, there's a 30-year transition period relative to technologies. What is happening in that space? And, obviously in the next, especially 10 to 20 period.
I'll make an initial comment and Richard will add to it. From my simple mind, the networks were originally developed to have electrons going one way and only designed for the electrons to go one way. The future is about electrons coming both ways, so coming from the houses and to the houses. And so there needs to be quite a different network configuration, technology around managing those two-way power flows. And there's going to be a significant amount of investment required to deal with a future that involves that sort of thing. Then there's things like load sharing and management of loads and that sort of thing through batteries at home and that. So a lot of stuff. Do you want to add to that?
Yeah, I think it's worth just summarising the categories of investment. So we talked about renewals, and maintenance. There's reliability is a big focus, and if you look at our asset management plan, we've been focusing on safety and making the network and the health of the assets right. There are some parts of the network which we need to really improve the reliability. Not all parts. I mean, overall, the network reliability has improved. Resilience is a big issue now. There's big investment going on planned in Dunedin to upgrade the 33 kV sub-transmission cable system to provide resilience. further resilience. And then there's network, and then there's the electrification and and decarbonisation. And that it boils down to two things. Firstly, network expansion. Where are we going to have? How are things going to develop, and when? So when are these connections going to? When are people going to start to cluster their electric vehicle usage? And will we have constraints on the network? And what do we need to do to address that? So that's capability and capacity building locally. But we also then have, as Steve mentioned, we've got to make our network a lot smarter. It's very dumb at the moment. You know, we can control it with one-way flows, as Steve said, but we need to invest in our advanced distribution management systems. We need to be able to almost manage real-time supply and demand on the network. So there's back office technology investments, and so there's an investment every area. There are new challenges, and some things are dropping off. As I mentioned earlier, some of the pole work, but you know, by and large, there are lots of other pressures arising from that.
So if I think of through Gig City and Chattanooga, I understand they run their internet and their electricity through the same fibre lines. But yet I haven't seen that happen in New Zealand yet. Is that or is that happening and I'm just not aware of it?
I'm not aware of that, Andrew. But I mean, this is one of the issues that Steve mentioned earlier. We've invested a lot in our SCADA and our communications network. So it's not the communications network; is the backbone is relatively resilient. It's actually the operating systems and our ability to sense what's happening in real time on the network. So you'll see us making a lot more use of smart meter data, so that we can actually monitor what's happening on a almost real time basis.
Last question. And since we're in public, I'll ask this question. Is there any, has being owned or under the council jurisdiction as such with the letter of intent been in any way a handcuff or frustration or blockage or anything that's allowed or stopped Aurora from being able to run at full speed should it have been privately owned or under a different entity?
No, to date we've had an excellent relationship with both the DCC and DCHL, the immediate shareholder. So, and if it hadn't been for that relationship, I think our job would have been a hell of a lot more difficult in terms of fixing up the mistakes of the past. So, no, not at all. It's been an excellent relationship. Yeah.
Right, Deputy Lucas.
Thank you. Steve, in your opening comments, you said that you, from Aurora's perspective, it didn't really matter who the shareholder actually is. You didn't really care who owns you. But if you look at it as, from all that you know, that's from the city perspective, what do you think would be the best if you're looking at it from a Dunedin city perspective?
I'm a ratepayer as well. Can I use that head? Look, no, it just comes down to, it's a regulatory framework. As you've heard, the role that a shareholder can play in influencing outcomes is pretty limited. So as long as we're comfortable that we can get access to the money that we need and the challenges to fund the challenges ahead, then that ticks that box for us. And, we won't be around if there's a different shareholder. So, but that's totally irrelevant. I'm working in a theoretical world. I don't think it matters.
I might.
Yeah. Yeah. I mean, it's a bit harsh to say, it doesn't matter if your current shareholder's a shareholder or not, but it's sort of the way it is. Yeah.
All right. Councillor Wiley.
This was touched on a little bit earlier, but I'd like to hear Richard's take on it. One of the things that someone who had knowledge of Aurora and of the industry said to me, he said, one of the issues with Aurora, it didn't have enough scale. And I want to get confirmation, because everything I've heard on the other side is that actually there is enough scale. And again, I'd just like to get an understanding of it, because part of what I've also heard is actually it would be very easy for, and this was touched on by previous councillors, for Aurora's head office to be taken away from the city and essentially have one company running a South Island Power Inc. Entity. So, but the key thing is, do we have enough scale under Aurora, and is the capacity and the growth enough?
Scale, as in the capacity of the staff and the people to run the business, or size of business. Yeah, well, I think, well, as Steve mentioned, Steve said, you know, we're the six stroke seven, depending on which way you cut it, largest out of the 29 Lions companies. I think it's 29 in total. So let's say, and we're a part of the Big Six group because we're at the cusp of that scale. And what that allows us to do, it allows us, as Steve says, it allowed us to attract people where we can offer them diversity of work. We can offer them some, you know, R&D and research and development in terms of what we're doing. We can plug them into the sector in terms of the leadership, and people like that, you know, and that's why they come here. And also they like the geographic diversity because our staff work across both Dunedin and Central Otago, Queenstown. But it is a very competitive market now. What's actually happening going forward, we've talked about uncertainty of investment, that new type of investment and the new technologies and the smarter way of doing things, it needs new skills and it needs new capabilities bringing in. And all the EDBs are actually fishing from the same pool, really. So we're at the level where at the moment we can sustain that. We have got the scale, and that will be my concern. I didn't say it earlier, but you know, creating a smaller business, I think, will be suboptimal from that and increase the risk of operationally, I think.
Councillor Wetherell.
Thanks, guys. There's a saying, cash is king, and I guess my observation of today is that Aurora hasn't got a lot of cash. Am I right in presuming that Aurora's main focus is its access of funding going forward, not the ability to provide a dividend in the foreseeable future for Dunedin?
Yes, well, that's exactly it. I mean, we've got to get access to the funding. If we don't have that, we can't implement the programs, and the company's exposed and the directors exposed to penalties and all sorts of things. So be back to the future if we weren't able to access the funding. So it's absolutely fundamental. The dividends are really just off to one side in my thinking. I mean, we're there to run the business and make it successful and meet the regulatory obligations, and to do that we need money going forward, and we know that we need that money for at least another 10 years, if not more, because we know we've got cash flow deficits. If the shareholder wants money, to me all that's doing is changing up the balance sheet of the company. It's got nothing to do with the profitability or the economic regulation. It's just that, and I think someone explained it earlier on today about the 10 million borrowing example, where really all you're doing is, if you're asking for a $10 million dividend, you're getting us to borrow it, the money to pay it to you, versus you borrowing to get the 10 million or rating for it. It's simply that. So I sort of see the dividends as a wee bit different from the ongoing business activity, whereas we just we don't have a choice around the business itself. There are choices around the dividends.
All right. I think we've exhausted questions, which means we've exhausted questions for the day. Do you, Greg, do you want to have a summation and a bit more of a talk? Because I think what we, councillors, would like to do is move to non-public to ask you a couple more questions thereafter.
Well, I think in the interest of time, and it has been a long day, we are over time, so we're more than happy to move to that public session and deal with those questions.
Okay, so non-public. So we'll take a break for 5 minutes so that we can finish with the cameras and stuff, and then we'll go to that. Because we're live streaming at the moment. So.